All right, it's 9 o'clock. We'll call the meeting to order. Why don't we determine the quorum? You're gonna want to call the roll?
Apple,
Here.
Brunken. Here. Clark, Liza. Gronland,
Here.
Gruis. Heineck,
Here.
Johnson,
Here.
Leonards,
Here.
Oakland.
Here.
Prim. Roth,
Here.
Salter, Seeley,
Here.
Stroder,
Here.
Terwilliger,
Here.
Cheddar,
Here.
Clark, Matt.
Quorum. All right, I'd like to welcome everybody. Make sure when you speak, you use the microphone so that the people online can hear us, and also so that the person transcribing today can hear us. And at times, if we're speaking too fast, she may ask us to slow down. So if you hear somebody say slow down, that would be her, because she's actually here doing it in person. So were there other announcements that we had? Any
Maybe I'd
introductions?
just make a couple. The first one is Dawn Smith sent me a text this morning to tell you all hi and goodbye. As you know, she recently retired, and unfortunately, April didn't work out for us with the weather, and we had to have a virtual meeting because that was going to be our send-off for Dawn, and it just didn't work out. So she did ask me to say goodbye to all of you. And then secondly, Doug and I were at Paul Schrader's Celebration of Life on Monday. And I just wanted to let you all know it was just a wonderful celebration of life. And as we were talking to family members, we did let them know that not only were Doug and I there for personal reasons, obviously with our friendship and the work that we had done with Paul, but we were also representing the staff at SDRS and you as a board, because we understood not everybody could make it. And so we were representing everybody. So, but it was a beautiful ceremony and it was nice to be there and glad that we were both able to make it. So just wanted to share that.
And like I say, it's all transcribed, and so also I wanted to mention motions will have to be read into the record. And there's actually wording specific stuff. There's suggested motions that you can maybe work off of if you want to change them a little bit, whatever you want to do, but we do need those read into the record as we go through the meeting. I don't think we have any other announcements, so. All right. All right, this is the time for the board to discuss any potential conflicts of interest. No written requests for a waiver were received prior to the meeting. Does any member wish to disclose a conflict and request a waiver now? If there are no disclosures, we will consider this item complete. And we will move on to approval of the April 1st, 2026 minutes. Wes. All right, can you read that into the record? Can you do it on the microphone, please?
I move approval of the April 1, 2026 minutes.
All right, there's motion from Wes Cheddar. Is there a second? Second from Myron Johnson. Any discussion? No changes, no discussion. All right, all those in favor say aye.
Aye.
Those opposed? That motion is carried. The next item on the agenda is public comment. Public comment is a regular item on each agenda that allows the public to discuss topics not listed on the agenda or items on the agenda that do not require board action. Additionally, the board will accept public testimony on any agenda item that requires board action. Anyone wishing to address the board must indicate their intent by signing in on the provided sheet. Speakers are limited to a maximum of 3 minutes, and all remarks should be directed to the Board of Trustees. Individuals may also submit written requests whether or not they speak before the board. For more information, please refer to the policy for public comment and public testimony, which is located next to the sign-in sheet. And we didn't have anybody sign up, and I don't see anybody here that wants to speak, so we will consider that item closed. Let us move on to item number 5, which is the SDRS Board of Trustees election, and I'll turn that over to Jamie for a report.
Yep, this year we had one board position up for election, which was the teacher position held by Penny. We had 2 candidates in the election, which was conducted by our election administrator, election service company. The results revealed Penny Brunken won the election with 87% of the votes.
All right, thank you for that report. And you saw in our packets the voter turnout, and it just becomes less and less. And if anybody ever has ideas of how we can maybe improve that, please don't hesitate to contact Travis, because we want participation from our members on these items, and it's not happening. So maybe they just loved you and wanted you to come back. So I don't know. Congratulations, Penny. Yes. So we need a motion to accept the election results.
I move that the Board of Trustees approve and certify the results of the 2026 Board of Trustees election as presented, confirming the election of the following individual to their representative position. Penny Brunken, teacher representative.
All right, I have a motion from Jake Oakland. Is there a second? From
Second.
James Apple, seconds. Any discussion? All right, hearing none. All those in favor say aye. Those opposed? That motion is carried. Let's move on to item number 6, which is the fiscal year 28 budget request, and Michelle Michelson will be presenting on that. I'll turn the mic over to Michelle as soon as she gets up here.
Good morning. I'm here to present the SDRS budget request for fiscal year 2028. The budget request consists of 2 primary categories: personal services and operating expenses. Personal services include salaries and benefits for our current full-time employee level of 35. Staff is recommending no additional FTEs and no increase to this portion of the budget. Operating expenses, which include travel, contractual, supplies, and capital outlay, are also recommended to remain unchanged. SDCL 312C 210 limits SDRS expenses to no more than 3% of the system's annual contributions. So our total budget for fiscal year 2028, the request is what you see on the screen, that's $6,857,241. Still remains below that threshold at approximately 1.9%. Travis, do you have anything to add at this time before I move on?
Well, I guess I could. I don't have anything prepared, but we're constantly evaluating our budget, and as we continue to leverage technology, of course, you see efficiencies in some areas that might free up some dollars, but then there's other areas where you may see a little bit of an increase. And so we've really been able to kind of stay within our operating budget that we have currently by, moving dollars around to other buckets within our budget to try to limit the requests, if you will. I will tell you next year, I am going to come in with something because, again, we've been leveraging technology and now we want to invest in our staff here as well. A lot of our positions here don't necessarily have those level of tiers like maybe the accountants do, say, for example, with the accountants 1, 2, 3s, and 4s. And one of the disadvantages of a small office, while there's far more advantages than disadvantages, but the one disadvantage is limited opportunity for growth. And especially when you have a young leadership team, it's very limited. And so if you can have growth within a certain department by hitting those, different tiers because of maybe longevity, educational markers, all those sort of things, performance, all those sort of things, and then we can add a pay increase for those, that shows how much we care for our staff here, because we have an amazing group of people that work here. And I firmly believe in the continuity and the institutional knowledge. I mean, that's what makes an organization strong. And we just want to continue to do that because, we've got some young people that are really good, and they're going to want to seek opportunity if they don't have the opportunity here. And so we need to make sure we do that. So I will be coming in with something next year. It just wasn't ready for prime time this year, but I'll promise you it'll be here next year. So that's really all I have, Michelle.
Okay. Next, I thought I would just kind of go over our budget request and timeline because it does seem a little crazy that we are talking about fiscal year 28 when it is June of 2026. So we'll begin with today's request, and if approved, SDRS will submit this budget to Bureau of Finance and Management in August through the state's budget system. In September, we'll meet with BFM and the governor's office to discuss that submission. In December, the governor will present the statewide budget address, which will include the SDRS budget. This may match the board-approved version or reflect changes recommended by the governor. If differences exist, the board will discuss them at the December SDRS meeting to determine whether to accept the governor's recommendation or maintain the board's original submission. The 2027, let's see here, there we go, legislative session begins in January, at which time staff will present the approved SDRS budget request to the Joint Appropriations Committee. The committee will then set the budget. This could reflect the board's version, the governor's version, or their own modifications. So the finalized budget then must pass both the House and the Senate. And once approved, the budget will take effect on July 1st, 2027, marking the start of fiscal year 2028. And with that, Mr. Chair, that concludes the budget request summary.
But it doesn't surprise me we work on budgets. I work with the state too, so. And then when you're working with federal money, you're even further ahead, so. One question that we have for 35 FTEs, are they all full right now or have any openings? Not that I'm looking for a job.
We do have one vacancy right now. One of the things when we have a vacancy, and this would have been after Dawn retired, of course, but it's from our records department. And sometimes what we'll do when we have an opening is we'll do a thorough analysis of whether that position is still needed. Again, when you're leveraging technology, sometimes that can free up an opportunity. And I don't like to go to the legislature and always just ask for an FTE because that's the easy thing maybe to do. And so what we do is we do a full analysis of whether or not we need that position. And that's what we're currently doing with that FTE. And then for our succession planning FTE, we're using half of that. And that's Jackie, working on a part-time basis, helping us with special projects. And she's worked with John and Sam with the succession planning on the legal side of things. So, but we aren't completely full at this point, but Dawn just retired. So, yeah.
I think that's a good point. As openings have happened in the past, we've repurposed positions, moved around, increased maybe communications or technology. And it's a good time to reevaluate if we're utilizing those FTEs the way we need to. So I think that's just a good thing to point out about the budget. Any other questions about the budget? Pretty standard, similar. So we will need a motion to approve the budget. Right, Penny?
I move to approve the fiscal year 2028 budget requested as presented.
Is there a second to that? Shane Roth?
Second, Shane Roth.
I have a motion second. Any questions, debate? All right, hearing none. All those in favor say aye. Those opposed? That motion is carried. Thank you, Michelle. Item number 7 is investment update. I have, well, there's a whole team coming up. Michelle, Jan, and Jared are all coming up, and I'll turn the microphone over to you guys. I think Matt is going to help out a little too. So.
Yeah, if I could add, Darcy's
Did I say
off having well-needed rest today. And so we're all jealous of her. But Danielle's going to cover the part that her and Darcy normally do. But any questions related to real estate or partnerships, I'll handle since I kind of help in that area with Darcy and Chris. And then Jan and Jared will, Jan will review equity performance and her and Jared will take questions.
Thank you. So for the SDRS fiscal year to date update through the close of the market on Monday, June 8th, If we exclude any estimate for partnership moves within the market, since partnerships only provide their valuations quarterly, STRS would be up a little over 9%. However, factoring in our best estimate for how partnerships might have behaved in the quarter, assuming they partially keep up with market returns, we estimate STRS would be up 10.75% to 11%. The markets have been pretty volatile, so that return could change a lot before the fiscal year end. Since our last update, we didn't reach any thresholds to make any major asset allocation moves, but the weights in some of our categories drifted sufficiently to hit rebalance triggers. Due to strong equity market returns, we sold approximately 1% of our public equities, and we also added about 0.25% to our investment grade bonds. We remain conservatively positioned, as we have been for a while, at a little under 50% equity-like risk. We are targeting our minimum in stock-like assets, including those that have a stock-like element, such as high-yield bonds and partnerships. As a reminder, our benchmark equity-like risk is 70%. The estimated total value of STRS assets as of June 8th is approximately $16.4 billion. With that, Jan will now provide a couple comments about how our internal equities have been performing.
Yeah, so turning to public equity for the fiscal year to date, the public equity absolute return is a little over 27%. Large cap global and small mid cap areas are both nicely outperforming their benchmarks for the year. For large cap global, a sector that stands out recently that's really helped us quite a bit is healthcare. And then in our small mid cap teams, the outperformance comes kind of from a variety of areas, including just being more heavily positioned in better performing industries and also benefiting from several kind of meaningfully sized single stock positions. That concludes our prepared comments. Turn it back to you, Mr. Chair, for any questions.
Yeah, we'll open up for questions. It's a good time to ask the experts here if you have questions. One thing you said, you move money out of some equities and into bonds. I mean, what kind of bonds is that? That's a pretty broad statement, I think.
Yeah, so the investment grade bond team, which is still Chris and Tammy, are the ones that kind of make that decision. We tell them that we have investment grade money to put to work, and with the help of the asset allocation committee, they decide what specific investments they want to do. Right now, kind of our consideration is between corporates, mortgages, treasuries. That's kind of what the broad investment grade index is. Or if we'd rather invest specifically in, say, treasury note bonds.
I suppose if you're investing in corporate, that actually is an equity-like risk associated with corporate. So that doesn't necessarily help with your equity portfolio, but.
Yeah, Mr. Chair, but Daniel, maybe it would be helpful if you had told them what we actually bought this time, and maybe what a couple of the items that we have bought in the last couple of years for bond exposure when we've wanted to add more.
We do that. So this time we did buy a treasury note. I believe it was one that was approximately matching the duration of the investment grade bond index, which is usually somewhere around, broadly say, 10 years. We also bought a tiny bit of a treasury bond ETF, which mirrors our investment grade bond benchmark, which is kind of that blend of investment grade corporate. So that's your really high quality, low credit risk, credit spread notes, a little bit of mortgages, a little bit of treasury bonds in with that also. Over the last kind of couple years, generally, we've been buying kind of that mix of treasury notes along with just broadly mirroring the benchmark with that treasury, the corporate bond ETF.
You see the kind of inflation headline this morning was about 4%, and I know there's a lot of talk about maybe interest rates going up. I mean, that's going to affect your bonds quite a bit. Is that been a consideration, I assume?
Yeah, so I can take it a little bit and then Matt will expand upon it. So our asset allocation process incorporates both inflation long-term and the kind of a blend of shorter term that affects both the bond valuation and the equity discount rates, the equity valuation. As you know, we have been at the kind of our minimum equity-like risk because we thought equities are expensive, but we've also been at the minimum bond-like risk because we thought bonds have been expensive for years, especially when rates were at zero. Lately, however, the bonds are starting to look, they're still expensive, but relatively cheaper than they were. And so we have been evaluating and continuing to look at what point we want to make more of a move towards benchmark weight in our bonds, but we're not there yet.
Yeah, Mr. Chair, I was going to suggest we also have Annie here as well. Annie and Danielle are high yield bond portfolio managers. So maybe they could discuss, you know, since the question is, well, about interest rates and the discount rate, you know, how they have thought about that in terms of the maturity structure in their high yield bond portfolios. Because the investment grade bond portfolio managers, Chris and Tammy, they would have to be thinking about the same thing. So I think it is a great question. And so I think it might be interesting just to let them, if we got time, to let them just chat a little bit about how they're thinking about interest rates and how it's affecting what they're doing. Even though mostly they care about the credit spreads and are these risky junk bonds going to go bankrupt, there is an underlying kind of a interest rate component to it.
So for the high yield team specifically, as Matt said, usually the most impactful part of high yield bonds is the credit spread because they're riskier names. However, there is a very large component of interest rate risk. And when spreads are tight, as they currently are, especially in high yield, the interest rate risk can have an even bigger impact. Also, our high yield index has started to gravitate more towards higher quality names, partially as private credit takes some of the riskier debt out of our index. And so then there's a bigger interest rate impact on what's left for us to look at and think about. Generally, for the last couple of years, we have been pretty short in our positioning, and now we're probably moving a little bit longer. In our portfolio, like in all of our other internal portfolios, we have different risk limits and things that we have to make sure that we're not being too risky on different components. And one of those is the duration of our benchmark. And for years, we were probably really hugging the minimum duration risk in our high yield portfolio. And lately, that has been extending more towards probably the average of our general benchmark duration, although probably still a little bit shorter, especially as if credit spreads are too tight, you don't want to be extending into super long bonds in those risky names.
Yeah, so maybe I'll just add a few things. One thing to think about with bonds that I think sometimes people forget is as interest rates go up, bond prices go down. They move opposite. And so when interest rates are zero, it's pretty easy to say, okay, we want to stay short duration or like shorter bonds because as interest rates rise, then the bonds that are the longest or the farthest out fall the most, right? And so it was pretty easy bet to say, let's stay short maturities on our bonds. Now, as the interest rates have risen, this would be both from the investment grade and the high yield side, it's kind of a question of, do we think the interest rates are fair? Maybe we don't want to take such a big bet against what our benchmarks say because the interest rates at this point, I think everyone in the room would probably say, could go up if inflation keeps going up, could go down if it, some things subside and the economy is struggling a little bit. So we're probably in a middle amount of risk. And so we kind of just are playing it more close to the benchmark of what that level of interest rate risk is. On the comment about credit, investment grade bonds do have, especially corporates, credit spread, which is the risk over a treasury. But the risk of like Apple versus the US government, I mean, would you rather own Apple or the US government? The credit spreads are pretty tight at this point. So we don't think you're getting a lot of extra return for owning credit spreads just because they're so tight compared to history. But at the same time, the US government is probably in a little worse place than history too. And so they've kind of tightened to that. So I think that's the thing we're trying to think about when we move our money in between different bonds and different maturity spots.
It's good. Yeah. I know a lot of people took a bath in bonds when they were long and the interest rates are going up and you can lose money on bonds that way. I think some of this we'll get into a little bit on the asset allocation too. So, But your partnerships and stuff probably don't get tossed around so much like the equities have been moving up and down. I suppose the partnerships are a lot more stable. Well, they don't report, so you don't even know, I guess. But has healthcare and that been as much all over the place as some of these other the market, or is that more stable? Or?
Mr. Chair, would you like, Danielle does work with Darcy on where to mark our partnerships. So if you'd like, she can comment about that.
It wouldn't
But then
hurt.
Jan could comment about healthcare as well.
Sure.
So a lot of the work that Darcy does is keeping up with the partnerships and what they say to us as their partners in these investments. So she gets a little bit of color for how their assets are doing, how they're feeling about them. And then she shares that with me as to where we want to mark and make our estimate, because we want the best estimate that we can for the return, but also to make sure that our asset allocation is appropriate and we're not getting, too much in equity-like risk or, not enough in the bond-like risk. Generally, our base case assumption, based on looking at history and how partnerships have returned, so that's including both private equity and real estate, is to say that the private equity partnerships kind of have about half the return of the public stock markets. And then we adjust that, kind of saying we estimate that about half of the return up or down as to if we think they're over or underperforming. That sort of, it's not a benchmark, but kind of our thought benchmark. And then real estate, we compare against the public real estate markets. And then you can also see based on kind of the types of assets that our partnerships are in. So if we own more commercial real estate than like the public REIT benchmark does, if those specific assets are doing better or worse, and that we kind of start with around a third of the return of the public REIT benchmark.
Mr. Chair, if I could add, those would be our standard processes for quick estimates of how we're doing. For example, they mentioned, well, where's our estimated return as of the close, the other night? And so that's for our early numbers. And in early July, probably the second business day, maybe even by noon the first day, we'll have a rough ballpark, maybe how we thought we did for the fiscal year. And it'll be based upon that kind of an estimation process. But the actual number, our official final number, we wait all the way until like August 15th. And that gives us the 45 days that these partnerships have to get their final results in. There's a couple tiny little stragglers that if the whole thing went away or tripled, wouldn't even be a basis point. Some old emerging markets things that don't come in. And so they get in the results whenever they arrive. It might be like 6 months to a year later, some tiny amount. But it doesn't move the needle anyway. But all the ones that are material, they all come in, by that August 15th, and then the accountants scramble to get those numbers wrapped up. And so our final results for the year will reflect, the actual numbers, not just our quick estimates. But during the year, then we use the quick estimates because they don't hustle to get the numbers in at the end of every quarter, only at the end of our fiscal year and at the end of the calendar year too, because some of their investors are calendar year investors. And so that's kind of how that works. So I hope that helps. And then, sorry, I didn't mean to distract you from the healthcare question.
Did somebody have someone healthcare? Yeah. Okay.
The most meaningful recent thing has been investments in the managed care area that have done really well. Managed care for the last probably few years has suffered from high utilization, and the pricing that the companies were using just kind of didn't offset the utilization trends. It also has had regulatory issues in terms of STARS ratings and coding and just a whole variety of different things that caused the companies to be really punished by markets, and in some cases possibly rightly so. And so, we've kind of evaluated that over time and used opportunities to lean into that where we felt we were being paid for the risks that we saw. And more recently, they've kind of had a nice rebound. There's been the Medicare Advantage rate came back a little better than was expected. And also just kind of some of the commentary and sentiment has turned a little more positive toward them. And so that's allowed the stocks to bounce back from fairly low levels. We still find the area attractive, but it just allows us to move things around, kind of like, we say, we're always looking to kind of trade out of the more expensive things and lean more into the less expensive things. And so these type of situations give us the opportunity to do that.
Now that's good to know. I always think that the year-end number ought to have an asterisk on it saying this is a snapshot of one day, because it doesn't necessarily give you a picture of what's going on in the markets. But we base so much of our information on just that one day. And I think we always need to take a look at more than just that one number when we make especially big decisions on our retirement system. And I hope people realize that. I mean, normally it works out, but right now we're up 11. I've seen some years where a month later you could be down 11. I mean, and does that really give you a picture of what's going on? Not necessarily. So, and it seems like the markets are getting whipped around, and mostly it's a lot of money chasing a few names and so much speculation. And it's hard to base a system and investments on you chasing those things. But so, all right. Other questions? I don't want to ask all the questions, but. And we'll have another chance to ask some questions during the asset allocation. I think we'll get into some detail. Anyways, thank you very much. All right, item number 8 is the projected funded status of the South Dakota retirement system. Doug Fiddler will give us a report. I'll turn it over to you, Doug. Do you have any?
Thank you and good morning, Mr. Chair, trustees. You've all seen this presentation before. Quarterly, it's our look at where we might be as far as at the end of the fiscal year. We're going to work off of that estimate we just heard of 10 3/4 to 11% and what that might mean for our results at the end of the year, particularly for our affordable COLA range. But on the COLA in particular, later on today, we're going to go into a presentation with a whole lot more depth and context on the COLA. So what you hear today, this is a little teaser of putting the COLA in context this afternoon. We always just like to remind you of the fundamentals. There's an equation at the top of the page: contributions plus investment return equals benefits and expenses. Every retirement vehicle has to satisfy that equation. And our goal is to keep that on a sustainable track. Most state retirement systems vary that employer contribution every year based on their actuarial results. We don't. Our COLA has been set in statute since 1974, and we vary our COLA to keep that equation on a sustainable path. We've got a long-term assumption for that investment return, the I in that equation. But every year we're going to be different from that, and the COLA is the tool we use to adjust to keep us on a sustainable funding track. When we can afford the full COLA range, and we've got a statutory process to determine that, we pay up to 3.5% wherever inflation is in there. When it's not, we reduce the top end of that range to what we can afford for the lifetimes of all of our members and stay 100% funded. 100% funded doesn't mean we have all the money we'll ever need. It means we're on schedule, right? And if we're behind schedule, if we're less than 100%, then we need to contribute more. And then the final piece of that, our statutory funding thresholds in 312C 228 say if we have exhaust the COLA, take that all the way down to 0 and can't stay 100% funded, this board's required to make a recommendation for changes, for corrective actions to get us back on track. So we've got some slides, 3 slides here of comparisons. You're familiar with this chart. On the left-hand side is our fair value funded ratio, our assets compared to the liability schedule, how much we should have in the trust. SDRS in blue, your median state plan in the red. And our goal is to keep that at or above 100%. On the right-hand side is the flip side of that. Is the employer contribution rate. So SDRS, we've been at 6% since 2002. We started initially at 5%. This is for our Class A members, went up to 6% in 2002. Your median state plan now, not your plan that's in trouble, your run-of-the-mill plan, their employers are putting in 2.5 times what SDRS employers are putting into the trust. And that can really impact hiring, right? If you've got a budget for an employee and you're trying to hire another employee, you've got a budget for an extra 15% for the pension. And that's an ordinary plan, not a plan that's in trouble. So if we look at NASRA puts together a chart of how much of state and local spending goes towards pensions. South Dakota is 1.75%. They do this based on census data. So 2023 is the most recent data available. Well, that's less than half of the median, right? So we're trying to manage this plan on less than half of what your typical state spends on pension. And then pulling from another report, I don't think we've had this in this presentation before. This is from a report done by the National Institute of Retirement Security. You'll remember Dan Doonan was here a couple of years ago presenting to the board from NERS. They look at the economic impact of the pension benefits being paid. And this ratio is that economic impact divided by your employer contributions or your taxpayer contributions going into the plan. You got to start at the right-hand side to find South Dakota on this one, right? And we're twice the economic impact per dollar of taxpayer contribution than the median, right? So you put these two together, we're spending the least on pensions in the nation, and we're getting the most economic impact. When we talk about defined benefit or defined contribution, one of the advantages of having this pension, this defined benefit plan, is that in economic dips, in recessions, this money keeps going out to the retirees and they keep spending it in the local economies. If your 401k takes a big hit in a market correction, people might start tightening up on what they're spending to adjust for that as well. This is in there. You've seen this. Long story short on this slide, we're paying retirees since 2002, since we last increased contributions. We're paying female retirees 10% longer. We're paying male retirees 20% longer. So if we blend that 60-40, we're paying your typical retiree 14% more years of retirement benefits. And then at the right-hand side, we're looking back 20 years with each of these data points, right? What we assumed we would get an investment return are the red dots, and what we actually got were the blue dots. And you can see in the early years of SDRS, we had a whole lot of investment return above our assumption. And this board recommended and the legislature enacted 11 benefit improvements. And they were significant, right? The initial benefit level was a 1% benefit multiplier, right? Well, now for service through 2008, it's 1.7. So that was a significant increase in the benefit. The initial COLA was a 2% simple COLA, and we've made a whole lot of progress in early years. Now, when we weren't able to make that COLA payment, and we had this great investment return, that is what led to that benefit multiplier increase. So a lot of those early years, instead of getting a hefty COLA, members got a correction through the legislative process to raise their benefits as well. This is really just to say the two exhibits on slide 5. We're trying to pay benefits a whole lot more with a whole lot less. We're trying to pay longer benefits with less as far as investment returns. And we have made a lot of efforts to tighten our belts, to focus on the core benefits, to eliminate ways members or employers could take action and get more or more valuable benefits compared to contributions than others, right? So we wanted to lock down so that we could pay the base benefits and the COLA as efficiently as we can. This is slide 7 has our COLA calculation of the COLA that we will pay next month, right? And it's a 2-step process. Step 1, we say if we pay that full COLA range, how much should we have in the trust? What's our liability number? We compare our assets to that liability. If that ratio is 100%, then we pay up to 3.5%. Well, it was 93.5% this year. So we went to the other side, the right-hand side of this chart, and said, what do we have to reduce that COLA, the top end of that COLA range? So if we pay that for the lifetimes of all of our members, our assets are equal to our liabilities. We're on schedule to fund these benefits with the continuing contributions. So that was a 1.56 COLA was the maximum affordable. And that's really the goal of this process is if we can't afford the full range, based on everything we know today, let's pay the highest COLA that we can sustainably afford to pay. Right, try and do the most we can, but keeping on a sustainable track. Slide 8 has the affordable COLA ranges in the green columns since we've been on this current COLA process, and the black dots are where inflation came in. We stayed pretty close the first 4 years. And then we had a couple of years of really high inflation that even though we paid a 3.5% COLA, which was the most we ever paid, we weren't able to stay very close to inflation for a couple of years there as well. So now turning forward to where we might be at the end of the current fiscal year, we generally expect that affordable COLA to stay level if things go as we expect. But if we have investment return above or below that long-term assumption, we'll adjust that. We'll also have liability gains or losses when we get the data on all of our members again and do these calculations. So we're going to look at some 1-year projections, some 5 years. We don't have the liability changes factored in because we don't know what they'll be until we do that process yet. And then we do rely on the investment office's staff for some investment portfolio statistics to do our likelihoods. We use a model here. It's not perfect, but it is pretty good for short-term projections. If we look at the left-hand column on the chart here, that is if our return for the year is what is listed in that left-hand column, then the baseline fair value funded ratio, that second column is that step 1. And really we're looking at, are we at 100% there? And then the third column is the effective COLA range we'd be able to afford given that investment return. The lines across the page at about negative 7.7% return for fiscal year 26, we would not be able to afford a COLA. We'd fall short of our statutory funding thresholds, and the board would be required to make a recommendation for changes, for likely benefit reductions to get us back on track. The middle shade of green across the page near the bottom at about 13.5%, we switch from being able to afford a restricted COLA to the full COLA range. There is a little discontinuity there, right? That it would jump from 99.99%, we'd be able to afford a 2.24. At 100%, we'd be able to, our process would result in a maximum COLA of 3.5%, right? So there's a jump there. Right now, based on what we heard this morning, 10 3/4 to 11%, right? If we look at that 11% number, we would be looking at a COLA of about 2% for the COLA being able to pay July of 2027. 2.5 weeks left to go in the fiscal year. Pretty volatile investment results, or day to day. They seem midday yesterday, right? They're swinging up and down. One thing we haven't factored in here is we are expecting salary gains this year. We go back to the July 2025 state inflationary increase was 1.25%, which was below what we typically expect. So we will get some upward pressure on the COLA. So if I had to take a best guess today, 11.5 or 12%. When we factor in the impact of those salary gains, 2.1% COLA is where we might end up. But that's going to change in the next few weeks. Inflation, this chart we've got one more data point on what you see on the screen than what was provided earlier, reflecting the release today. Can't read it. 3.65% is where the May number was compared to our July, August, September 2025 base. If we project that out, just going those extra really 2, 3, and 4 months to our 3 months that we'll use in the average, it annualizes to 4.9%, just on a projection of where we are through 9 months of the process, with 3 months, approximately 3 months to go on that. So it looks like a big inflation number coming again. Likely we'll pay the top of our affordable COLA range for the July 2027 COLA. Again, a couple more weeks in the investment results, and then have to go through our whole valuation process to see where the liability numbers come in. So when we take the thresholds that we saw on this chart, the minus 7.7 to be able to avoid a corrective action, the 13.5% to be able to afford the full COLA range, and we're trying to put likelihoods on those from the beginning of the fiscal year. We're trying to chart the likelihood of returns that would take us into that range. So the red area here is trying to quantify what did we expect from the beginning of this fiscal year was the likelihood we'd have to make a corrective action at the end of the year. And we were looking at a 12% likelihood at that point. 88% likelihood, then it's kind of business as usual. We're able to afford a limited COLA or the full COLA range, depending on where investment returns would end up. That 12%, we've been tracking that historically, so that would tie to the right-hand column here, where we've been since we've been on the current COLA process. Started out about 15, crept up to 24%. Two numbers in 2021, because at that point, the board recommended removing the 0.5% COLA minimum to take us to a 0, which gave us a little more room. Good investment year took us down to 3% likelihood, and that it has crept up a little bit since then. So those were from both of those slides. These last two were from the beginning of the fiscal year. If we try and look now where we might be next fiscal year using the same process, well, a couple of weeks ago, we had to pick a return to run with, and we picked following a 10% return. So this tells us what would this look like the following year if we finish up this year at a 10% return. And we would take that, you see, we could afford a little bit more negative return, a little bit bigger loss of about 10.7, which would take the likelihood of corrective action then down to 7%. Right, so we would get a little more room if we have a year this year above our 6.5% assumption, but we're not factoring in that the market seems to be at all-time highs right now as well. We're not incorporating that into here. We get a little bit worried that when we always have a 80 to 90% chance of not having to make changes, that we get complacent. And so if we look out 5 years where the investments might be, we wanted to kind of try and quantify what's the likelihood that in the next 5 years we're going to have to make changes. And this is from the beginning of the year, that's a 32% likelihood, like a 1 in 3 chance we're going to have to intervene based on what happens in the market and our process. Remember, we're tied to fixed contributions that are essentially the lowest in the nation trying to fund a pension plan, right? So we're going to have something that adjusts, and a fair chance that we will have to make changes. Again, this is why we keep that planning for the good times and bad times, our contingency planning document, why we bring that back and revisit that periodically. So we at least have a structure for what to do. We have another version of this as we try and say, okay, well, how would that change if we get a 10% return this year? It reduces that likelihood of corrective actions, but not by very much. Takes it down to 30% instead of the 32. I think trying to guess where the investment markets might be 5 years from now, there's a wide range of possibilities, right? And there's fairly significant chance we could have to make corrective actions. And just the summary, we have paid that 3.5. It's been a few years now, and the COLA has been ticking down since then. Right now, if we had to take a best guess, knowing it's not final, don't hold me to this, it'd be 2 to 2.1% where we might end up for the July of 2027 COLA. With that, Mr. Chair, I'm happy to take any questions.
People have questions? You pointed out the disconnect on that 13.6. I see it on that slide there, but you go from, oh, we could only afford like a 2.24 at 13.5 and all of a sudden $1 more and we're up to the full 3.5, basically at most higher inflation. It does seem like a disconnect. And
yeah,
I remember the logic when we decided that, but sometimes you wonder if maybe it should be looked at a little bit again to why we didn't just do the full range and basically figure out what you could afford. But I mean, it's a whole discussion that we aren't going to go into here, but eventually you might have to go through that again.
Exactly. And at the time, the thought was if we're 100% funded, inflation isn't always going to be at the top of our range, and we could afford to take some variation, some COLAs above our assumption, which would generate losses, and hopefully have some inflation comes in below our assumption, and we would have gains. But I've come to dislike the fact that we could have one day in the market takes us from a much smaller COLA to a bigger COLA. I'd rather this be gradual. So if at some point we reopen the COLA, this might be something we look at, that we limit this so we don't have that big jump based on 1 percentage point of return difference. We've seen this cause a whole lot of trouble at some systems. And so it's mathematically, it's just not a pleasant result when you have a disconnect like that as well.
I think we were basically saying our assumption of long-term inflation would be around that 2.25, and that's so you'd be sometimes above, sometimes below, but overall it'd be kind of that would be the average. But when we're running such a fine line all the time, it makes you wonder if maybe we should have considered that a little deeper. So, other questions? Otherwise, I thank you for your presentation, and we'll move on to the next one, which would be asset allocation. Maybe I'll have Matt, if you want to introduce everybody that's going to be speaking here, I'll turn it over to you.
Yeah, thank you. And I think I get to do the first slide in addition to, I guess, the title there as they get seated. Whenever we're ready, we can flip to the next slide. And yeah, so this presentation is an extract of a more detailed presentation that's given to the Investment Council every year. And so the council, their role is to, determine, a benchmark for and ranges for asset allocation for the STRS assets. And, we want to be able to try to accomplish our objective, which we list on there. And it's in our annual report as well. First we want to achieve and hopefully then exceed the council's benchmark over the long term. So all of the investment team, their efforts every day is to try to, beat that benchmark, but, we know the first goal is to just accomplish it over time, because that benchmark is what we believe will give SDRS the best chance to have a good outcome for its members over the long term, and which balances, trying to earn the current promise benefits, but trying to help us keep up with inflation the best that we can, and to balance, avoiding, getting into that red, and we can't accomplish one without ruining the other in full. So we have to try to balance all of those things. And so, and that asset allocation benchmark is the most important decision that the council and any pension plan has to face. And so ultimately, we have to consider kind of our expected long-term returns, but the risk in the short term, that we can survive to get to the long term, and that we can continue our investment approaches, because if you do bad enough in the short term, maybe you don't get to, keep doing what you're doing to get the long-term outcome. And so ultimately the council did select the benchmark. And so I think we'll see in our presentation where it says recommended, but it was approved, both the benchmark and the minimum and maximum allocations for every category. So now if we move to the next slide, the people that are going to present today, Annie and Jared and Danielle, and we'll be covering this today. They'll be covering Darcy's normal portion as well today. And we're going to talk about how we think about risk and return, how we assess those things, and they'll review the benchmark recommendation that was provided to the Investment Council, which was adopted, and then the expected long-term return from that benchmark allocation, which are part of those statistics that Doug Fiddler just referenced a little bit ago, and along with the volatility of around that expected return. And then they'll be talking about how we value stocks and bonds and other asset categories, and then how we implement our asset allocation changes over time. And so I think Annie is going to lead off, and her and Jared will kind of cover kind of the benchmark parts. And then Jared will talk about, the expected return for equities. And then, they'll kind of be mixing around then all of them on the parts after that. So take it away.
All right. Thank you, Matt. So I'm Annie Sipperly. I've been at the Investment Council for 17 years now. I'm mostly a high yield bond portfolio manager, but I'm also on the asset allocation risk committee, and I'll let the other two introduce themselves when they start speaking. Before I start, this year I'm going to try to make this a little more conversational. And so if it's okay with the chair, if people would please ask questions as we go along. And if I say a term that someone doesn't understand, please just ask me, because as I realized from my sister who's in the medical field, like when you're not necessarily in the field, you don't know all the terms. And so it's easier if you just ask while we go along. So in my part of this presentation, we're going to start by, when you think about asset allocation, it's really about how do you allocate your assets to different categories and why. And so the first thing we look at is what have been the returns and the risks of different asset categories over time. And there's really only a handful of assets or asset categories that have history of returns over the long period of time. And those are cash, bonds, and stocks. You can actually get some stock returns back to the late 1800s, which is kind of shocking to believe, but it's nice to be able to see how all these assets respond in a downturn. That helps us judge the risk. And so that's why we look at those three asset categories. What we learned along the way, and what we'll go into more in this presentation, is that equities return the most by far over the long term, but they also suffer the biggest declines. And so with that, you can put some bonds in and get some diversification by having bonds, because they decline less and sometimes they move in opposite directions of equities. And so the bonds are really there to diversify the returns and help dampen the risk of the equities, but the equities return the most over the long term. And equities is another way to say stocks, just so everyone is aware. So now moving on to the next slide. This is a graph that I show my 7-year-old before I give this presentation every year. He's 7 now. It was 5 before, but it's basically if you have grandchildren or children, this is why they should invest early and why compounding works over time. So the blue line is if someone had invested $1 in the S&P 500 index in 1926 and where it would have grown to today. I mean, you can see on the chart, it's above the $10,000 mark. It's just a huge return from compounding. The red line is if you had invested in an investment grade type bond or index, kind of had to link things together for that one. But if you had to do that since 1926, you put $1 in, you'd be at about a little over $100. So what this chart is trying to show and what it should show you is that equities returned about 103 times more than bonds. So if we had 50 to 100 years to invest and none of us were here to get worried about volatility along the way, you would want to be all in equities and not own bonds because their returns have been so much better. I will say, though, that this is the U.S. stock market's results. And as everyone has probably realized, the U.S. market has been exceptional over the long term compared to other stock markets. Some have even disappeared completely, like Germany after World War II. And so this might be more of a best case outcome. On to this next chart. This chart is kind of complicated, so I'm going to walk you through it. The 0 line is the dark black line, so that's 0%. Anytime the line crosses the 0% line, that means equities and bonds performed the same over an average 10-year period if it's the blue line, or over an average 20-year period if it's the red line. So anytime the lines are above 0%, that is the extra return you got for owning equities over that 10-year time frame. So if you look at, let's say 1988, you got about 7.5% more return on average over the 10-year time frame by owning equities versus bonds. That's what we're trying to show here is the premium you got over time to own equities. As you can see in this chart, most of the time there's a premium to own equities over 10-year and 20-year periods. Sometimes there is not. And that happened in the late 1930s, 10-year period, you would have underperformed by owning equities. In the 78, 79 period, you would have underperformed by owning equities. During the Great Financial Crisis, you would have underperformed by a lot if you had owned more equities than bonds. And the reason for that is that the Fed had historically loose monetary policy during that time frame. And so I think I always refer to how Howard Marks, who's a bond manager, talks about bond returns, and that is that over that time frame from after the financial crisis until 2022, when rates were very low, that's actually the most abnormal time period for bonds in history. So we think of that maybe as more normal now because we've lived through it, but being close to a 0% treasury yield is not normal. It's actually very abnormal. And so that the returns were so high for bonds during that time because of that. Then as rates started to move in 2022 to be where they are today, we saw the worst bond return in 100 years, which was actually in 2022 when it was down 15%. So that's kind of the situation here. But this chart is basically just to show you that equities have performed the best over the long term, but sometimes you have to wait 10 to 20 years in certain cycles for that to get that premium. So on to risk measurement, how we measure risk. Most people in this industry use standard deviation and correlations to measure risk of asset categories. So basically, standard deviation is how volatile are the assets? How volatile is each asset? Does the equity return whip around? How does the bond return work? And correlations are a judgment of how assets move together. So will the bond go up when stocks go up or does it go down? And how can you help diversify by knowing those correlations? So what we do, though, is I try to use Sioux Falls as an example. So when I moved to Sioux Falls in 2022, or not 2022, sorry, when I've lived there for like 17 years. But what I noticed for the first 3 to 4 to 5 years is we kept having what the weathermen kept saying were 100-year flood events, like every 2 years, right? It's like the streets were flooded. And at one point I said to myself, well, this can't be a 100-year flood event because it's happening every 2 years. So the statistics aren't reflecting the reality of what's happening here, right? And we noticed the same thing for stock returns. We went back and looked at all the stock returns, what happened in history. And what we realized is that standard deviation and a normal distribution did not really reflect stock returns. Stock returns, more negative events happen than statistics would suggest, and they're much worse than statistics would suggest. So like those weather events, we tried to think through, okay, if these happen more often, we should up our volatility because they happen more often and the magnitude is higher. And so we up our volatility measures. And then the other thing we do is that the correlations between asset classes, if you look at history and you look at crashes, they all tend to move together. If people are selling equities, they're not like, well, we're going to sell my US equities. They're also selling their international equities. They're also thinking about, should I be in high yield bonds? And so things start to move together. And so we try to think about that during a crash. But in the end, what really matters when you think about your investments as a person is over a 2-year time frame, can you survive? Because if you have a investment manager and they have a terrible 1-year return, you as a person are saying, oh, well, that's kind of iffy. But if it happens 2 years in a row, you're kind of getting really nervous and you're thinking about stuff. We understand that there's a psychology to investing. And so we try to think about, okay, maybe we can withstand a bad 1-year return, but can we withstand a bad 2-year return? And that's where we get to the next slide. So on the next slide, these are cumulative downturns for equities that have been worse than 20% in history. So 2-year returns that have been worse than negative 20%. What you will first notice is that this says equity returns. That's because bonds have never returned negative 20% over a 2-year time frame. The worst was in 2022 when rates moved. It was negative 15.6%. So really, when we're talking about risk, it's equity moving down. And so you can kind of see from this chart that during the Great Depression, equities fell 70%. That would be very hard to live through again. The next worst 3 were the most recent, 1974, 2002, 2009, where equities fell 40%. And when we talk about equities falling 40%, that's absolute returns. It's not relative returns. So if we think from Doug talking about, we have an expected return every year, let's say the expected return for equities is somewhere around 6.5. That means over 2 years, we should be getting a 13% return. And if instead you got a negative 40%, you're underperforming your benchmark by 53%. So these are things that we really think about of what kind of risk that we can actually take. The blue bar on this chart that's really short on the right-hand side that looks out of place is actually what the worst 2-year return for equities has been since the Great Financial Crisis, and it's positive. So think about that. Think about the tariff situation last year in April. Think about COVID. None of those lasted very long. In fact, COVID was like a month, and then I was so mad the market rebounded. I was so ready to buy all the things and couldn't do it. Okay, and then the April tariff thing, it whipped around within a couple days, and you couldn't really do much about it. Okay, so we're talking about 2 years where returns just keep going down, and we haven't seen anything like that. And I started in the industry in 2009, so I went through some industry downturns, but we haven't seen anything similar to that. So we know that's coming, and we want people to be aware that this has been a pretty abnormal time frame. The next chart is very similar to the last chart. In fact, the red bars are the same. It's 2 years where equity returns have been below negative 20%. The red bar is the same as the red bar on the last chart, but now we're adding in other bars with different allocations. So the red bar is all allocated to equity. The blue bar is 85% equity, 15% bonds. The green bar is 70% equity, 30% bonds. The yellow bar is 40% equity, 60% bonds. So what you can see from this is as you add bonds in, there is a pretty big diversification benefit. You don't go down as much during downturns. And so we try to think about, hey, what's the appropriate level of risk that we can take? And we can put some bonds in our portfolio to lower that risk, especially when we think equities are overvalued. And so those are kind of the main things that we think about on the risk side. And now I'm going to turn it over to Jared, who will discuss what our benchmark recommendation is. Yes.
I got a question on this one.
Yeah.
The chart there in the 2002 Q3, where it shows the 40-60, that's got to be the outlier year when you see the small 40-60 yellow. I mean, so bonds must have been really, didn't take much of a hit that year, I'm assuming.
Yes. So that would be right after the tech bubble. And so most of that stock market crash was due to tech companies that didn't actually have that much debt, that were way overvalued, not actually making any money yet. And so they took a hit, but bonds, usually when you have a big hit in the market, then the Fed comes in and lowers interest rates, which moves bonds prices up. So bonds actually return more. And so in that situation, due to that type of crisis versus like a great financial crisis where it was a debt problem, then you have different movements in bonds. But that one was more of an equity tech
That was
investment.
more isolated, I'm
Yep.
assuming. Okay.
Yep.
Yeah, and that was the beginning of when Alan Greenspan lowered rates to zero. So they came from mid fives to zero, and bond prices went up quite a bit.
It survived that and go. Yeah. Okay. That's what I was assuming, but just checking.
Yeah.
Thank you.
Keep us on our toes.
Okay, thank you for the opportunity to present. I'm Jared Edlin. I've been at the office for 23 years. I work on the small mid-cap strategy and on the executive committee as well. As Annie discussed, I think it's really important to put in context the return since the GFC, the Great Financial Crisis. I started following stocks in about 1998, and so I had the opportunity as a very young person to witness what happened at that period. But also, if you think about people that started just after Annie, they've never experienced a downturn in the markets. And as we showed in those graphs before, market downturns do happen. And so our job is to prepare our asset structure so that we can endure those inevitable declines in the market that'll come. We just don't know when they're going to come. So we'll talk a little bit about our benchmark recommendation. And so our recommendation shows here a 70% equity-like risk, 27% bond-like risk, and 3% cash-like risk. Now, these levels attempt to balance the aspiration for long-term returns with the tolerable drawdown risks that occur in situations like I just discussed. A benchmark different from these structures, more equity-like risk provides a higher return, but also comes with higher risk. Likewise, an equity allocation lower than 70% provides lower risk, but also has a lower return and risks the outcome of meeting our benefit structure. Annie will discuss a little more on the benchmark return and volatility on a future slide. As you can see in the chart above, this is our equity-like risk recommendation of 40% minimum to 85% maximum. The 40% minimum is well below the benchmark level of 70% equity-like risk, which lowers our absolute return to the plan when markets are elevated and risk levels are high due to overvaluation. This minimum 40% level still provides a meaningful allocation to equity-like risk in case the valuation is wrong or is intolerably early. In the past couple of years, we've reached thresholds that suggested equity-like risk fall to our 40% minimum. However, due to some of the partnerships and real estate funds that we have invested in, we can't actually meet our target of 40%, which brings us to our approximate 47 to 48% current equity-like risk. We also have a minimum requirement for our public internal equities of half of the minimum suggested equity-like risk. So that combination doesn't allow us to actually get to our 40% minimum today. On the other end of the range of 85%, the maximum level of equity-like risk provides an opportunity when markets are cheap for us to take advantage of those opportunities. We want to capture that higher potential when the rewards for bearing that risk exist. When others are scared and the prices of equities decline, we view the risk in equities to be much lower and view our opportunity to be much more robust at that point. On page 11, we recommend the range of bond-like risk to be 15 to 60%. The minimum level of 15% provides solid diversification even when equity markets are cheap. And the maximum level of 60% provides the opportunity to take a larger overweight if bonds are attractive and stocks are expensive. We, however, don't allow the maximum bond weight to get as large as the maximum equity weight because over the long term, as Annie discussed, we recognize that stocks have significantly outperformed bonds, and we have the ability as long-term investors to capture that additional return. This slide shows our benchmark ranges, and the objective in selecting benchmark ranges is to attempt to outperform over time by having less equity-like risk exposure going into downturns and more equity exposure during recoveries. Not all downturns start from overvalued markets, but we do want to, when markets are overvalued, we want to be properly positioned. It's important to recognize that these shifts occur frequently and can be painfully early. It's essential for us to be patient for at least 3 to 5 years or more so we can capture the premium returns that equities provide. Annie will now talk a little bit about benchmark construction.
Okay, so before I start on how we construct the benchmark, I think we should talk a little bit about what a benchmark is. So a benchmark is kind of like a baseline or a measuring stick to compare how well our investments did. So it's basically something that should be easily investable in without great skill. So everyone at this table should be able to buy index funds and could own this benchmark. That's the goal of creating a benchmark. What that we're measured against is adding value above that ability to buy index funds in these asset classes. And so we only include asset classes in the benchmark that could easily be invested in. So that includes public equity, investment grade debt, cash, high yield debt, and real estate investment trusts, which are basically allow investors like you and me to buy stocks in real estate without owning just real estate. Okay, so that's what's in our benchmark. There's some secondary categories that are not included in our benchmark, but we can invest in permitted ranges. Those include things like private equity, opportunistic real estate, and hedge funds. Those things, most of the time, there are some rule changes coming down the pipeline about ability to buy some of that stuff, but like most of the time you need to find a manager, they're illiquid, they get locked up, and the opportunity to invest in them can be more difficult. And so we don't include them in the benchmark, but we allow investments in them if we find great managers with high returns. And then when we do invest in things that aren't stocks or bonds or cash, what we do is we map their risk to stocks, bonds, and cash. So I'm not going to give you an example, that's the secret sauce, but like say we had an asset class that we thought was 50% equity-like risk, 40% bond-like risk, 10% stock-like risk, then that's how we allocate its equity-like risk, its bonds-like risk, and cash. We separate the assets out. And so each asset class that isn't cash, bonds, and stock is allocated a specific risk level. And then we use all of those different asset categories to get to a benchmark of 70% equity-like risk, 27% bond-like risk, and 3% cash-like risk. We think this benchmark would be good, and you could invest in it yourself. We want to have a long-term investable benchmark that you could do yourself, and we would recommend that the council invest to a benchmark like this and rebalance to it through thick and thin if they lost confidence in staff to add value above the benchmark through our investment process. So next slide, if I can do it. Okay, this slide, there are a lot of numbers, so I'm gonna go pretty slow. So the blue line is the it says proposed benchmark for FY27. We usually give this meeting before we give our investment council meeting. And so it's kind of flipped this year. And so it's already been passed. So it's our benchmark for FY27 is in blue. So that showed you the weights to each asset category that is in our benchmark. So 56% would be to public equity, 22.8% to IG debt, 1.9% to cash, 7% to high yield bonds, 12% to the real estate investment trust. So that's kind of the baseline allocation for our benchmark. And then what we said is, okay, using more of a consensus industry inputs of returns and volatility and correlations, let's see what the consensus view would be by the market to come up with what our expected return would be for our total fund, right? And so we take JP Morgan's expected long-term returns as consensus, because a lot of people use them. We take their standard deviations and their correlations, and we combine them with the weights in our benchmark to come out with, we think the expected return using their inputs would be 6.41%, and the volatility, which is the 6.41% is in the dark blue box up there, and then to the right of that box is the volatility. So we would think the volatility would be a little over 12% using their inputs. Our actual asset allocation as of 3/31, so what we were actually invested in as the office, not the benchmark we judge ourselves against, but what we invest in is the gray line below the blue line. And so that shows you, we're 20.6% in public equity, 39.7% in cash. So we're more conservative than our benchmark, hence why the return that we get from our expected returns is lower for our actual asset allocation, and our standard deviation or volatility of that return is also lower. So next slide. Earlier in the presentation, I talked about how we, come up with our own volatility for asset classes due to the fact that we don't think standard statistics work very well, and we need to have a wider volatility because equity returns can have different mathematical returns than a normal distribution. And we also adjust our own correlations so that they're more correlated during downturns. So using our inputs for expected long-term returns, which we just think JP Morgan is a little short-sighted on what our pension fund thinks about for how the time period. And so we adjust that a little bit. We widen out our volatilities. And then the blue line is still the same benchmark weights for different asset categories for our benchmark. But we're using our own inputs here to come up with, we think our expected return long-term is the 5.97% with a higher volatility of the 14.97%. And then the gray line again is also where we currently had our assets at as of 3/31 or March 31st. And they're more conservatively positioned, and thus the return looks lower at 5.1%, and the volatility looks lower at 10.5%. What I will say here is if markets fall, the return potential could be a lot higher, and our strategy is to buy when markets fall, and so we could invest in at much higher return levels and end up with higher return levels than this slide shows. All right, so this next chart really shows where our returns could end up over the long term over the next 20 years. So the yellow line shows what we expect our return to be for our benchmark of 5.97%. And the blue funnel represents where our returns could end up being. So it could end up being lower or higher. You can see that the funnel starts to revert towards the mean because it's a lot harder to have 1 year of 20% returns, next year of 20% returns. Like that just doesn't really happen in markets. Usually a good or bad year that's significant is followed by a less good or bad year. And so over time, the standard deviation range compresses. And so that kind of just gives you an idea, though, that there could be a wide range of outcomes of returns around this expected level. So this slide is just summary. It shows you that our benchmark asset allocation expected return is the 5.97%. As we talked about earlier, this is a midpoint of a wide distribution of possibilities, emphasized by the previous slide in the funnel chart. This return also excludes any potential added value from our contrarian investment approach, and it also excludes the effects of negative dollar cost averaging, which results from our negative cash flow position. So that we've talked about that a lot, but maybe I'll give an example of what negative dollar cost averaging is. Okay, so Doug talked about it. We take in less contributions than we pay out for benefits. So every month we pay out more in benefits than we take in contributions. So we have a negative cash drain on the fund. It's not very much. Doug can correct me. It's like 3%. Okay. So let's just pretend, and I'm not making this recommendation for your investments, but let's just pretend you hold 100 stocks in your investment portfolio for retirement. And you need $1,000 a month to live on in retirement. Let's say the 100 stocks you own are the same and they all trade at $1,000. So every month you have to take out $1,000 so that you can live. So you sell one of your stocks at $1,000. Well, let's say that during the next month, the stock falls 50%. So now it's only trading at $500. Well, you still have to take out $1,000 to live on, unless you're like rice and beans and whatever, but you have to take out $1,000 to live on. And now you're only left with, instead of being left with 2 stocks to do that. So you can't ever catch up. You can't bring that stock back. So instead of having, 98 stocks, now you only have 97 stocks. And so even as the market rebounds, you automatically have that loss. Okay. You don't get the rebound. And so the problem with having a negative cash position every month is you kind of have to offset that, especially if markets decline. And so I thought it was worth explaining that's kind of what we're dealing with. And now I'll pass it over to Jared to talk about additional risk control that we have for the fund.
Thanks, Annie. So in addition to the benchmark construction, we have additional risk control, which I think is really important to put in context. I think about as a member of the investment council and as a member of the STRS board, we have a fiduciary duty to the members. One of the oldest members was my grandma, who started as a teacher at USD long time ago, and just started retirement after this fund was created. So she had a long time receiving benefits, lived to be 96, outlived the actuarial assumption at the time, certainly. And both my parents and both my in-laws draw benefits from the retirement system. And so I think thinking about risk is a really, really important concept for us, and we want to manage that in an appropriate way. So there's other ways that we manage the risk in our fund, and I think it's important to focus on that because during market downturns, we want to be able to deploy our money into stocks. We listened to Warren Buffett talk about an investment he made in July of 2008, where he invested in Mars Wrigley. I think he put $6.5 billion into that company, but it was a commitment to make that investment in October of 2008. So in July, he didn't know what was coming in October. And had he had stretched a little bit on the cash that they were required to pay, as many managers did at the time, they maybe invested in something that yielded a little bit more, maybe stretched to get a return so that they could outperform their benchmark. And then the financial crisis hit, and a lot of those asset prices fell substantially. And the commitments they thought they could make, they weren't able to honor. We take that very seriously. So when we make asset allocation decisions, when we talk about holding cash, we hold cash. We know that in any kind of market environment, that cash is going to be worth $1. And it's not going to go down in value because we own short-term treasuries that are guaranteed by the U.S. government. Another way that we have diversification in our fund is the equities we own. Because of our investment strategy that Jan leads, a lot of the portfolio managers tend to lean into areas that are not as overvalued in a market that may be similar to today. And so we have what we consider to be cheaper assets. They're still very good companies, as Jan mentioned, in the healthcare space as an example. And that provides a ballast in in the stocks we own, even in a market decline. I think that we can go on to the next slide. I'm going to talk a little bit about our equity valuation process. So first, we think about estimating the future cash flows. Equity valuation is a very important driver of how we think about asset allocation, and it is what informs all of our decisions around when to move in and out of stocks. So we estimate the future cash flows of companies at a micro level, and then the index at a total level, so the S&P 500. And we do that through discounting back future cash flows, because all the value of a company is the cash it's going to end up paying you through dividends. And much of those dividends come a long way in the future. So the value of equities is very sensitive to assumptions that investors make today based on what they think the future is going to be. Also, a very important consideration in the value is the growth rate of those earnings and dividends over time. We calculate both of those based on historical returns on capital, which we hope smooths out the business cycle. We think that's really important, not to get too excited when things are good and also not be too scared when things are bad. Because over time, the U.S. financial system and the innovation that comes from the companies that are involved in that has endured the test of time. Danielle is going to talk in a future slide a little bit more about what the discount rate is comprised of. And it's an important part of how we, they call it present valuing, or we say how much money today would you pay for those future cash flows that are going to come from stocks. We also have some adjustments to the value of the market. We make monetary stimulus and restraint adjustments. Is the Federal Reserve being accommodative or restrictive relative to what we think is normal? And then our earnings above or below some range around what we think is kind of a normal range. And if they are, we give a little bit more credit. If they're below, we give a little bit less credit. This slide shows it's a logarithmic scale of histories, which helps you see the ups and downs, further back in time. But you can see the volatility in the black line, which is the actual reported earnings of the S&P 500. And the red line shows our smooth normal earnings. And you can see they're much less volatile over time. And we think the earnings have become more volatile maybe since the earlier periods due to a number of factors, some of which are obvious, some of which are not obvious. But there's a lot more leverage in the economic system. The Federal Reserve, or the U.S. government debt is much higher than it was in the past. We think some of those things will continue on into the future. We wanted to break down a couple periods because I think it's important to put in context today's market and as an example of a couple periods in the past. So if you look at the top slide here, that shows the current earnings of the S&P 500, and you'll see a little dashed line to the right. That's our estimate of the current quarter's earnings. We don't have the finalized numbers until the end of this month for what the first quarter's earnings were, but they're high, and they're projected to get even much higher in the coming quarters. But we wanted to say, like, hey, how did that compare to past times when we thought the market was also expensive? So we have two other time periods, 1974 and the year 2000. And so you can see that we don't know what the projections were at the time of future quarters at that point. We just know that those are the quarters where earnings actually peaked and then came down. You never know exactly why earnings are going to start falling. And certainly the quarter before they start falling, people weren't suggesting that they were going to fall, because much of the discussion in the markets is all about, well, things are getting better today, so they're going to get better in the future. And we know over time that doesn't always happen.
Hi, I'm Danielle Maurer. I've been with the investment office for 19 years. I'm on the high yield debt team and asset allocation implementation team. So on this slide, our internal asset allocation model uses numerous components to derive the equity discount rate. The discount rate is what we use to discount the earnings to a present value in order to calculate our current fair value of equities. The first component of the discount rate is the real T-bill yield estimate, which is the short-term rate. The key components account for the relationship between the real yield and real GDP growth, plus an adjustment for the effect of taxes on income due to inflation. We estimate our real GDP growth using a blend of long-term and shorter-term averages. The longer-term average can capture the longer-term structural changes and is long enough to encompass a full economic cycle. The shorter-term average is more responsive to changes in the economy as they are currently happening. Expected inflation is also based on a combination of long-term and short-term averages. Furthermore, we use an estimate for a T-bill to 10-year spread, the 10-year to 30-year spread, and an equity risk premium. So I'll turn it back to Jared to show how this calculated fair value of equities has compared to price over time.
So this is the culmination of all of our equity valuation work that's done. You can see history back to roughly 1960 shows the volatility around the black line would be what we estimate the market to be sort of a fair value at that point in time. And you can see back in the year 2000, and the market got to about 180% of fair value. There's a purple line, I believe it's purple, on the far right. That shows the current market valuation as of when we created this slide deck in sort of mid-May. I think it's gotten a little higher since then, but it's approximately where it is. And you can see the valuations can drift far from our expectation of normal. And they can stay above and below for quite some time. And we and other contrarians are frequently too early. As it's difficult to know just how far or how long market valuations will be above or below normal. However, when predetermined equity thresholds are reached, our allocations are adjusted, and then the challenge for us begins of enduring the pain of being wrong for a while. Sometimes this wait is short, and oftentimes the wait is 2 or 3 years, but can be 5 years or more. The Investment Council and the STRS board and legislators are an important part of the role in encouraging the maintenance of this discipline during difficult times. Now I'll pass it to Danielle for the implementation discussion.
Maybe. There we go. So this slide discusses our asset allocation implementation process. Equity-like and bond-like risk over and underweights are based on the valuations. Equity-like risk can be adjusted up or down from our benchmark of 70% to a maximum of 85% or the minimum of 40%. The steps up or down from this benchmark are triggered by the degrees of under or overvaluation, or how rich or cheap we model the asset categories to be. We want to be more overweight a category when it's cheap and more underweight when it's expensive. Bond-like risk can also be adjusted up or down from its benchmark weight, but depends on the amount of room left after the equity-like risk level is determined. The equity-like risk gets determined first because, as Annie showed, equities are more impactful. However, the equity valuation is determined in part relative to the bond valuation, so we save some of the bond allocation for when bonds are more attractive. The steps up or down from the benchmark are triggered by degrees of under and overvaluation. Other asset category over and underweights depend on the valuation relative to the blend of stocks, bonds, and cash based on the risk mapping that we use for each of the categories. Any impact on the equity-like, bond-like, or cash-like exposure from under or overweighting these categories is neutralized by adjusting the weights of stocks, bonds, and cash. So today we've walked you through an overview of our asset allocation process. We hope you have a better understanding of how we assess risk, how we structure the benchmark, how we value the major asset categories, and finally, how we implement the process. As we have followed and refined our program over time, we've recognized that absolute discipline in implementing this process is essential. The ranges and risk measures must be well understood and followed. But there's also a component of luck involved in that the market actually needs to hit our asset allocation triggers in order for us to make an asset allocation move. Over time, this type of luck has probably averaged out for us. perhaps luck has favored us the most and that the market has muddled along with our rough sense of normal, which might not always be the case. That concludes our prepared presentation. We would open it up to any further questions.
Other questions? This is basically the abridged version. You guys do the unabridged version at the investment council meeting, which is in June.
That was last
It
week.
was last week. And if anybody ever wants to get into the depth, go and listen to that, because we used to kind of encourage people to actually go to that. I know it's a lot more than some people want to know, and we actually did some meetings together as joint meetings, but it becomes a very long meeting for having to do all of our business and all of their business together. But I would encourage people, if they're really interested in this, is to go to that meeting and listen, because it's a lot of good information.
And I'm guessing Matt would invite you to any meeting
Mhm.
for the investment council if you so choose.
Yeah, everyone's welcome to every meeting, and if anybody ever wants to come to town and get a walkthrough over any part of this, we'd be happy to do that. And these folks, and there's another half dozen of them back in the office that as well as Darcy that work on all of this, and so you can really get the details from all those teams, and some of them are younger people, which is amazing how smart some of those young people are. Of course, probably the ones that are here today, those three and Jan, they're the ones that make them smart and pick out. Of course, their parents probably made them smart. They were smart before we ever got a hold of them, but these guys help train them. And so it is nice to see how they think. And I think you'd get comfort even seeing how responsible some of the young people, are on thinking about these issues. And so you're welcome anytime. They can walk through that 2-hour presentation with you, and, it'd be fun for them, just have some caffeine first is my suggestion.
They all look young, don't they? And it is really a high overview of what we're seeing, because if you actually get into the office and he went through like the research and stuff that they do on all these different companies, and there's so much detail that we don't see, that you get in there and they start talking about anything. It's mind-boggling, and it gives you some comfort in that, of the detail that you guys go through with the money. And I think everybody that's involved should see that, but not everybody's that interested or needs to do that. But I would encourage people to if you get a chance to go down there and tour the office and go to that meeting in June, especially, or any of the meetings, because it's just amazing the details, and you see a lot of it because you're there. But yeah. Are there other questions? I know the markets can be a real they whipsaw around, and you mentioned that a little bit, and how the diversity can kind of temper some of that, but you still see it. And actually sometimes it's a good thing when the markets go way down, then it's a buying opportunity. I know that days Tammy talked about being there alone on Christmas Eve and moving hundreds of millions, even $1 billion around, because the markets had hit triggers, and of course you don't sit there and buy individual stocks in some of those triggers. There's other tools that you use, which you've detailed in the past, but I guess I'll just one more chime for some questions. Otherwise, we'll thank them. And
Mr. Chair, in my years of education, I said there was never a dumb question, but I may have it. But I guess I'm thinking about all of the dollars that you're handling, our money, right? You talk about asset allocation and what percent is going to go into stocks, what's going into bonds. What part, how much is that? There's going to be some of our money invested in something. So how do you know how much you can invest? We got the benchmarks there, but some stock looks hot right now. So you're going to, but $20 million in that, or who controls that? How do you say, well, I think that we should spend this much money on stocks today, or bonds today. I don't know, it's not simple to me. How do you do that?
Great question, Myron. Thank you.
We hold you responsible too.
So from a bottoms up perspective, each of our portfolio managers is responsible for a bucket of money. And within that, they have ranges around both the individual securities that they can buy and then the sectors that they can buy. Then that's all rolled up into a core portfolio that Jan manages, which also has similar stock and industry maximums and minimums that they're allowed to own. We don't want to have any one person have 100% of their portfolio in one stock, because that would create much more, the volatility we have calculated doesn't take into consideration an idiosyncratic risk from one stock having a problem. So that's how we build it up from the bottoms up, much how from a total asset allocation, we have those risk limits as well around how much we can have in any given sector. We have those same limits on individual securities. However, each manager, and then this occurs on the high yield side as well, each manager is allowed within that range to have autonomy when they see an opportunity to take whatever opportunity or whatever allocation they think is appropriate for the potential they see in that situation. And for each of the managers we have, Danielle and Annie may look at the same bond and have different opinions on it. And so their determination of the opportunity is different, and then their positioning is different. And we think that's actually another good diversification of thought, and so that we don't get too much groupthink and everybody does the exact same thing.
Yeah, and I would add to that from the way the office works is that we have Matt, who kind of oversees everything, and then we have these teams of like the executive committee, the asset allocation committee, that does sort of this valuation work and says, okay, we think that stocks as a group are this price to value, bonds as a group are this price to value. And so amongst that, we want to allocate, plus or minus from each of those benchmarks. And then we take that money and give it down to the portfolio managers. And as Jared said, we have, like the core portfolio manager, but then kind of the sub equity. So yeah, so there's different levels and there's different people looking at different aspects of it, saying that, okay, we think in aggregate it's this cheap or expensive, but then down at the industry level or down at the company level, it's this cheap or expensive. And so you have a lot of people doing a lot of work on a lot of different aspects to try to get what's hopefully the best asset allocation.
So I'll just give you like a very simple example. Like I cover 250 companies, right? So let's take Six Flags is one of the companies I cover. They recently did a big acquisition with Cedar Fair. They merged together. It's an amusement park. The consumer, especially at the lower end, has gotten tighter. And so they can't spend as much money on amusement parks. They've lost a lot of attendance. So the question for me as a manager is to decide, can they keep pricing up the same? Can people really afford to pay $70 a ticket to go to Six Flags? The pricing went up like 40% post-COVID. What pricing do I think makes sense? And then can the attendance rebound or not? Because that's going to determine the value. So then we're putting in inputs for stuff like that and getting outputs of what we think the stock is worth based on those inputs, or what we think, can the company survive this sort of downturn? And so that's what we're doing on a day-to-day basis with companies, is trying to think through, does it make sense that people can pay that much? Will attendance rebound? Do we need this many Six Flags theme parks in the US? So on a basic level, that's what we're going through every day. And really trying to figure out in our head, how much money can they make? Can they lower costs with having fewer workers? Do workers have to get paid as much? We're going through drilling into every company like that when we do investments.
I think the bottom line, thank you very much, but bottom line is there is a very defined checks and balance system. And that's very important. Appreciate the information.
Yeah, and just a little more on that. Our investment council approves all of those limits, and so they're kind of the governing body of us. We propose those things, and they approve and are aware of all of that. So
Yeah, go ahead, Wes.
This is probably not new to you, but just back to your comments, Annie, about inflow of money versus the outflow, inflow being contributions, outflow being annuities paid. And then you have a factor there where employees in the public sector is decreasing. I'm a retired representative, but I'm on the Brookings School Board. And we know this last cycle, well, for next year, we're down several employees, and this affects contribution. This has to be happening all across the landscape of our public employment in South Dakota. After decades of new federal money, new programs, whatever, the tide has shifted. And so while I say this again, repeating myself, that you're fully aware of this, but I'm not sure our membership understands that this is a challenge that kind of adds to the variability of some of your thought process in terms of what the projection is out in the future for contributions, which when I was on the board in SDRS board years and years ago, the contributions far outweighed the annuities paid. And at some point, I don't know when, you would know it, Travis, there was a kind of a cross, it crossed the line where we are today. And I just, as an observation, it's not a question, but it's a thought process that I'm sure you dealing with this on a regular basis have thought about, but just important to verbalize that from time to time, as we have, I'm sure, hundreds of listeners to our meeting today, and we as board members have to consider this, as well as Matt, you and your team think about this with regularity about what's out there in the future relative to contributions versus annuity payments. Thank you.
Yeah, Wes, great comments. It reminds me of, when we used to manage the cement plant retirement system separately, that plan, was closed, to new members and became, a shorter duration item. And so, if there's no new money coming in and the amount of money going out increases over time, then we have to recognize, we've got a not as much permanence and growth and may cause the staff to make our benchmarks more conservative, kind of separate from the fact we think the markets are high.
Well, the system has matured, and I remember the whole discussion about how the outflow, the incoming, but there's quite a power in having a team of professionals that's investing my money and a set plan that we stick to, because on their own, most people don't have the time to do that kind of research. And also they don't usually have a plan. They're usually trading on emotion and buying high and selling low. I was good at that even my own. But that's why it's so important to have that plan and stick to it and have these professionals working on it. There's a power of grouping our money in and having a system like we do. Go ahead, James.
For you other board members, if you haven't had a chance to go through it down in Sioux Falls, I've been on the board for 9 years and I've stopped in twice, and I don't let Matt know when I'm coming in. I just happen to be there and I pop over, and Matt's taken me through twice in 9 years, and it's time for me to probably take another tour again. But it is absolutely amazing watching them work in there, and it looks like they're talking about the screens. Their computers are twice, 3 times the size. There's screens everywhere. There's numbers running. You feel like you're at Wall Street, kind of walking through the departments there, and just watching them work and go through there. And Matt takes me through and talks me through a bunch of the stuff. And it's really an amazing opportunity if you get a chance, if you're ever in Sioux Falls and you got a chance to do it. And I just happened to, my wife and daughters, hey, we're going shopping. I'm like, well, I'm going to go hang out with Matt for a while. And it's, for me, that's way more fun than shopping. And so I go through there, and he's taken me through it twice. And it's just, I learned so much when I go through there. So if you ever have an opportunity, and I'm not trying to push everyone to go invade Matt's office and take you through, but it's really a really good opportunity, and you learn a lot, and you learn what's going on, and he breaks it down and talks it through, and the people are, they're making trades right then, or investments right then, or making decisions, and it's really you can see a team atmosphere in there, kind of like what Travis has here, and it's really interesting, and really it helps you appreciate and learn more of what's going on. So again, if you ever have an opportunity, you're in Sioux Falls and you know you don't want to go shopping or go out to eat, go sneak over there for a couple hours. It's absolutely a great opportunity. So again, hats off to everything you guys do in the office and Matt with his team there, because I learn a lot every time I stop down.
All right. Well, if there's nothing else, I'd like to thank you, and I think it's a little time for a little rest break. 10 minutes. So we'll come back at 11:05. Turn this on. Okay, so we'll call us back into session here. And our next item on the agenda is, where are we in here? Long-term benefits. Yep. Hey, all right, review of long-term benefit goals with Doug and Travis. So,
Yeah, Doug and I are gonna tackle this agenda item together. It is going to be actually the next two agenda items will probably take in the neighborhood of 2 to 2.5 hours. The long-term benefit goals are long-standing goals of the Board of Trustees. And just like with our contingency plan and other documents that you as a board have, we review these on a periodic basis. And the last time we reviewed the long-term benefit goals was in 2021. So for a lot of you that are newer to the board, this is going to be your first deep dive into all of this. So I would encourage to ask questions as we go through the long-term benefit goals. This is going to make the presentation go much better. And again, at the end of the day, these are your goals. So you really need to and have to provide feedback to us. I'm going to call you out on that. I'm going to challenge you. Matter of fact, after each slide, I will pause as we go through the goals and ask for feedback. Part of it is I'll be covering a lot of the slides, and I want Doug to have an opportunity if there's anything that I missed, which probably will happen. He can chime in, but also we want feedback from all of you. It's actually critical. In the digital binder, the SharePoint page, when Jamie and I sent out the materials, we had our long-term benefit goals document. You can reference that if you want, or just follow along with the presentation, which probably makes the most sense if you just follow along the presentation. Doug and I have worked on this a while, and Jackie was a part of those conversations as well and working through this. We have a couple of very minor changes, and I'll reference those as I go through the presentation. At least with my slides, they're pretty straightforward, pretty minor, but there could be some additional items that we come up with as well as we have discussion on all of this. So with that, knowing how long it's going to take, I'm going to jump into the first slide. And I think, Doug, we didn't really coordinate on this, but maybe you can navigate the slides for us, or maybe have Jamie do it. Somebody anyway. I don't have the controls. So really, as we kind of look at our agenda today, or look at before we get into the goals, I think we really have to ground our conversation really with our mission statement and our vision, because at the end of the day, those guide every decision that we make as a system. When you look at our mission statement, it really, in my view, emphasizes two core responsibilities. The first is maintaining a financially sustainable system, and that's operating on those fixed contributions that we operate under, that fixed budget. And then the second, of course, which is extremely important as well, is preparing our members for that retirement journey when they decide to go down that path. And I think that this just really reinforces our roles as stewards of a disciplined, I guess, kind of self-correcting structure that I believe really protects both of our members and our employers at the end of the day. So everything that we bring forward today or discuss really has to be evaluated through that lens of sustainability as well as member readiness. When you go into our vision describes where we're committed to not only being a fully funded plan, but a model retirement system. It also, when you look at the vision, it really underscores the long-term goal of delivering benefits that meet policy objectives without compromising that sustainability at the end of the day. So ultimately, it's really about ensuring every member has a strong foundation for financial security and retirement at the end of the day. That's our goal, right? Whilst remaining fully funded. So with all of that in mind, as we have these discussions and those sort of things, we just have to make sure that everything that we discuss directly supports those commitments at the end of the day. Again, strengthening our funding integrity, enhancing member outcomes, and maintaining our position as one of the leading retirement systems in the country. Next slide, please. I don't know who's doing that. Okay, thanks, Doug. So when you look at our funding and long-term benefit goals, You know, at STRS, we've always taken that very long-term, disciplined approach, and that's to setting both our funding and our benefit goals at the end of the day. And I think our goals really kind of serve as that anchor to our long-term stability. I think they keep us aligned with our mission statement and our vision. And again, I said it earlier, they've guided us in our major decisions that we've made over many years now. And they've also helped us maintain a strong financial position. I said that earlier as well. But sustainability is and always will be the top priority, right? At the end of the day, we have to operate sustainably on that fixed contribution structure. And that was established by the legislature dating all the way back to 1974. And we made that commitment that we would make this system work on that fixed, modest budget. I think we've held true to that, and we need to continue to do that. So again, the most important objective continues to be staying sustainably funded over the long horizon. So when you look at the role of our benefit goals, I think, establishing, clear long-term benefit goals. And we heard the folks talk earlier about benchmarks, right? Why we have those. Well, these serve as a benchmark as well. And they provide us an opportunity to evaluate whether our benefits are adequate for our members at the end of the day. I think these goals also help us gauge how well the system supports retirement readiness for our diverse membership that we have as well. They also provide us with a bit of a framework when we're considering any sort of benefit improvements, or on the other side of it, if we have to make any adjustments to the plan, if we're in a corrective action position. Our contingency plan, in my view, is kind of an extension of that at the end of the day, right? We work on that periodically as well. That has to remain nimble as the environment continues to change. Our benefit goals, to me, they ensure that our discussions stay grounded in long-term strategy rather than short-term pressures. When you look across the country and you look at those systems that have struggled, a lot of that has come as a result of short-term pressures and making maybe decisions that weren't completely sound at the end of the day. And I've always admired the fact that we've maintained that long-term strategic mindset at the end of the day. They also help us evaluate the potential changes in a consistent mission-aligned way, and they also ensure that sustainability. So why assess the goals now at the end of the day? And I think when you look at goal assessment, I think it's most effective when you're not in a crisis or you're not in a position of surplus, like when we were working on the contingency plan. It provides you with that opportunity to thoroughly discuss and fully vet possible solutions or how you would react to those given environments. I think it just makes the most sense. So I think it's the ideal time to take a step back and just make sure our goals are still appropriate and make adjustments proactively rather than reactively. You guys have probably heard me say this before. One of the things that I've always admired about the Board of Trustees is the fact that we've always operated in a proactive fashion. That dates all the way back to 1974. Of course, I wasn't here. I was only a couple years old. But I do know everything I read and the studies and those sort of things. They've always taken that approach at the end of the day. So what Doug and I intend to cover here today, again, we're going to throw a lot of information at you. We're going to review our current benefit and funding goals. We're going to evaluate how our benefits compare to those goals today. We're going to consider whether those goals remain appropriate, given current conditions and long-term expectations. And then we'll outline any sort of potential changes for you to consider. I kind of already alluded to it at the beginning. We have a couple of very minor changes, but as we have discussion, maybe there will be more that'll come out of this. And so this is a high-level strategic discussion that we definitely want your feedback and need that feedback at the end of the day. One of the things that I forgot to say maybe in the intro is when we did this back in 2021, we actually looked at this over 3 meetings. And so we're fully prepared, obviously introducing this to all of you today and having these discussions. We're also fully prepared that we may need to come back in September and further discussion our discussions maybe in certain areas as well. Or maybe we have the full discussion here today and know where we want to land. Regardless, it's going to take a couple of meetings, because what we'll do is we'll go to work on the document and then bring it to you in September, and you would adopt it there. So really today is just good discussion and pointing us in the right direction, kind of giving us a thumbs up to proceed with any of the changes that get recommended today. So next slide. Sorry, I kind of drug on there, Doug. Of course, as fiduciaries, you carry a heavy responsibility, right? At the end of the day, this is one of the heaviest responsibilities that you probably could carry, especially when you're considering 105,000 members, and that's going to continue to grow. And it really, again, it all kind of starts here. When you look at that fiduciary duty, John and Sam have presented on this in the past. We've also had Rob Goss, so I'll highlight this briefly. But I do think it's important to note that we have first your first fiduciary duty is the duty of loyalty. And when you look at that duty of loyalty, that requires our trustees to, put the interest of all members and beneficiaries ahead of any sort of self-interest or any interests of any appointing authority. It also means that you're serving the entire membership fairly and consistently at the end of the day. And we have to avoid those conflicts of interest or any form of self-dealing. Next, we have the duty of prudence. Of course, we are expected to approach this role, or your role as trustees, with the same care that a prudent person would apply in similar circumstances at the end of the day. This includes preparing for meetings, participating, asking questions, seeking additional clarification if you need to. And then, of course, documentation is vital as well, just to make sure that we show that we've demonstrated sound and informed judgment when we've made these sort of decisions at the end of the day. We also have the duty to follow the plan. I think that's pretty straightforward, kind of by the book sort of thing. We gotta follow the plan according to the plan documents at the end of the day. And again, we have to document everything that we do, and we do that. So when we look at the implications for our benefit goals, again, you guys have heard me say this, you've heard Doug say it. You probably think we sound like a broken record at the end of the day, but we do operate on that fixed contribution structure. And so we don't have the ability to increase contributions to solve funding challenges. I really appreciated the discussion earlier when we were talking about risk. And Jared kind of alluded to that. Again, heavy responsibility here. And we want to keep this plan sound at the end of the day. We have tough decisions to make, both on the benefit side, so the liability side, as well as on the asset side. And we have to make sure those work well together. So really, when you look at our long-term sustainability, it depends on managing the benefits, the assumptions, and the plan operations overall. And every decision that we make has to be evaluated in terms of whether that we can keep the plan sustainable under those fixed rates. Of course, we have a very diverse membership as well. It spans over multiple classifications and generations, each with different benefit structures and expectations. And we have to make sure that our benefit features remain balanced so that no single group, whether it's by class, generation, or status, receives some sort of disproportionate advantage. And I think this helps ensure confidence in the system when you take that approach with all of your membership. With the COLA process, I'm going to save that one for the next presentation, because another thing that I forgot to allude to at the beginning is we separated the COLA out of this particular presentation. It is one of our goals at the end of the day, or one of your goals, but we felt like it deserved a little deeper dive at the end of the day. We understand that here recently our COLA has lagged behind inflation and those sort of things, but there's a lot more to that story. There's a lot more detail, a lot of things to unpack there. So we wanted to separate that presentation. So I'll touch on that COLA one in the next presentation. So on this slide here, I should just follow along here because we have a number of benefit goals. And you'll see on the slide here that we last updated those in 2021. I'm not going to spend a lot of time on this slide. You'll see a few of those that are highlighted in the blue. Those are different areas where we'll take a little bit of a deeper dive into those. Not that the others aren't equally as important, because all of your goals are important. Some of them just might deserve a little more color at the end of the day. And that's the ones that are highlighted in blue. So again, right before I jump in the goals, I'd just like to say that, again, feedback is critical here. So we're gonna go ahead and get started right into the goals here. With the first goal is sustainability. And this also will be the mark of our first recommended change to you as a board. If you looked at the document and compared it to the presentation, there's a different order to that. And as Doug and Jackie and I were talking about this, it seemed more logical with the flow that we're presenting here today. And so one of the changes that we would recommend is to adopt the order of the goals that were present in the presentation to the actual document, that flow, because it just seems like it makes more logical sense. And so we're going to start with sustainability. It's a pretty straightforward goal, in my opinion, and that's to maintain and enhance the long-term sustainability of SDRS. Really, it's just ensuring the system can preserve the current benefit structure well into the future. Again, I think this is essential when you're looking at a fixed contribution environment where, sustainability has to be actively managed at the end of the day. It can't just be assumed. When you look at our current provisions and the practices that we have that support our sustainability, over the past several years, we've systematically addressed numerous inequities, subsidies, in some of those areas or provisions that maybe had resulted in higher than anticipated costs in the system. The system has expanded the use of the variable benefit features. Those help us maintain our affordability and stability during economic volatility. At the end of the day, that's a lot of that's a mouthful right there. I didn't realize that when I was typing it out. But it's important to look at those sort of expansions that can help us with our the sustainability of the plan. We've also continued to strengthen our risk analysis. You hear it in Doug's presentations when we look at the update on the funded status. We look at it during the valuation. We look at it in a number of different areas. Investment side of things, again, we just heard it today with the asset allocation. And I know the presentation that those fine folks bring to the investment council, each one of the board meetings. I mean, risk analysis is huge on both sides. And we try to continue to strengthen that because that's going to help us with our modeling and all those sort of things to continue to help us be sustainable into the future. We've also had a number of initiatives that have resulted from our long-range planning process, and those have been adopted and implemented. And again, just reinforcing the long-term health of the system at the end of the day. So not to dwell on this goal too much, because I do think it's fairly straightforward, not that it doesn't deserve conversation, but I look at this goal as being achieved today, but it's an ongoing responsibility at the end of the day. I think when you look at sustainability, vigilance has to continue at the end of the day and have these sort of discussions. We can't just put it on a shelf and say, well, we've achieved that goal. Let's move on to the next one. We have to look at this ongoing. So with that, I don't know if anybody has any thoughts on our sustainability goal. I know Doug and I don't have any recommended changes here. Doug, you can certainly jump in if I missed anything on this goal.
As long as we're invested in the markets, we're not going to have this locked down 100%, right? And there's that balance between being able to provide to fund these benefits that are adequate and appropriate with the risk of downturns. And I know Matt and his team are actively involved in trying to manage that risk as well. You heard that a minute ago, right?
Thoughts from any of you as board members? Again, sustainability might be fairly straightforward, so we'll probably have other ones that you'll chime in on, I'm guessing. All right, so we'll go to the next goal. And our next goal is total retirement income. And again, Doug and I thought it just made sense to now go to looking at total retirement income first before you start diving into all those income sources at the end of the day. And our long-term education goal is to really help our members plan for retirement income replacement of 80 to 85% of final average compensation. When you look at the income sources for that, there's really three. And a lot of you have probably heard of the three-legged stool concept. I know our staff here at SDRS use that concept. So the stool is your retirement security at the end of the day. And to balance that stool, you have to have three legs to that stool, and that represents the income side of it, right? For the retirement security or the total income. The first, of course, is the SDRS benefits, and we're going to talk more on those today. The second is Social Security benefits. We really won't dive into the Social Security benefits too terribly much because we really don't have much control of what those benefits look like at the end of the day. We know that depending on your wage scale, because it is a social program, it's going to provide you with a certain level of income replacement from Social Security, right? And then we have our personal savings, and we'll dive into that a little bit. And it's really those three that work collectively together that provide you with that comprehensive retirement planning, kind of balance that stool out at the end of the day. So when I look at how we're doing here at SDRS, I think we consistently meet the education and promotional portion of this goal. When I look at our planning sessions and our modeling tools, written materials, counseling efforts, all those sort of things, they really, at the end of the day, assist our members in I guess, understanding and reaching that 80 to 85% target at the end of the day. Of course, our education efforts are ongoing, and we're going to continue to enhance those as well, especially as we recognize, our members' needs may change as well, right? But that is a part of our holistic retirement approach at the end of the day, is the three-legged stool concept. We offer a variety of vehicles that help our members reach that combined income target. Obviously, the SDRS benefits, but looking more at the personal savings, we have our supplemental retirement plan. Of course, that's a 457 plan. You can invest in that on a pre or post-tax basis, and you can use that vehicle to help you with your savings. We have our supplemental pension plan, SPP. That is the account that we have available for those unused sick and annual leave balances. That's just another vehicle. And I think I called a supplemental pension. I got it mixed up with the SPV, the special pay plan. Sorry, I got that mixed up. But that's that vehicle that we can use for those sick and annual leave. We can use that as a resource for income as well. And then lastly, it's our SPB, our supplemental pension benefit. That's an annuity-like product that we offer here at SDRS, where we can take those SRP or SPP dollars and turn it on to income, lifetime income. And it has features that are very similar to SDRS when it comes to like Survivor and different things like that, the options that you have. But again, another vehicle that our members can use. And I think for our members, I think all of these options just offer flexibility and then tax efficient ways to provide income. So again, when I look at our members' ability to meet the goal, I think when you combine SDRS benefits with Social Security as well as their personal savings, almost all of our career members today are on track to meet that 80 to 85% goal. And of course, that's assuming they retire at normal retirement age. Should they decide to retire earlier, that's going to be where the planning comes in. And maybe you have to put more away on a personal side to achieve that goal. So again, I think the key takeaway for you as a board when it comes to this goal, I think we're achieving it. I think we have the framework there that's needed for our members to achieve that, that strong income protection at the end of the day. And of course, we just will continue to educate folks.
So if I could chime in here, Travis, for a second. The income from is highlighted because that's just a suggested wording change, just to make that a little bit more parallel in the goal. And then we will dig into this in a few slides on why the 80 to 85%, and we're going to demonstrate for members currently retiring after the career definition, how they're meeting that or whether they're meeting that. So we're going to dig into this a little bit in a few slides.
Actually, before maybe we have even discussion on this total retirement income, Doug, if we could just go to the next slide on the 80 to 85%.
Did we have another comment there?
Oh, did we have a comment? Oh, sorry, I missed.
Just a question. On the special pay plan, are the restrictions on that federally mandated, or is that a decision that's made here? So, because of course we get people that get the payout and they want to be able to put it in there and they're not able to.
Yeah, so when you look at the special pay plan, that's under the Internal Revenue Code 401A. And so they set the kind of the tone for what we're allowed to do and not allowed to do within that particular plan. Of course, we can set the thresholds of, as far as the income level of, do you have to have $5,000 of, payout for the unused sick and annual leave balances and those sort of things. We have certain things we can do. I think there's minimums and those sort of things, but it is set by the Internal Revenue Code.
Some of the minimum thresholds were set because of the expenses to the employee, and they wanted enough money in there to at least cover the cost of that. There is some play on some of those thresholds, but yeah, a lot of that's IRS rules.
A lot of it's through the code, though. Yeah. Any other questions before I jump into the next slide here? Doug's got it changed for me. So a lot of you might be asking, where did we get the 80 to 85% benchmark? And for us, it's really a guideline. One of the things that we always tell our members is there's no one size fits all when it comes to planning for retirement. However, when you look at the 80 to 85% replacement income range, it's really widely used in the financial sector when it comes to retirement planning and those sort of things. For us, we believe that it provides kind of that useful reference point for our members. Looking at when you combine your SDRS benefits, Social Security, and personal savings. But again, it's just a benchmark, and we know that our actual needs are going to vary from member to member. So each member at the end of the day is going to have a kind of a unique retirement income target. And it's gonna be greatly influenced by the income that they need, by some of the things that they're going to experience when they go to retirement at the end of the day. It's going to be different for every one of us. And we've got some factors up on the slide that will impact some of us, maybe all of us, or maybe none of us. When you look at the first one, you're looking at the end of your career, probably not making contributions to SDRS, Social Security, personal savings. You maybe are still doing a little bit on the personal savings side, but maybe not at the same level that you were while you were working. When we look at our work-related costs, we're hoping that those get reduced after retirement at the end of the day, right? So that might be helpful in our income planning. Looking at the spending patterns, those differences in the pre and post-retirement. Health factors, of course, that's not even just what the insurance cost would be, but the health factors going into retirement, and where our medical needs going to be, and how much is that going to cost and impact what we can do in retirement. What's our desired lifestyle when we retire? And we talk to individuals all the time. You might have one individual in the room that thinks the ideal retirement is to go buy that brand new Lazy Boy chair, binge watch shows on Netflix or Apple TV. That sounds like the dream to that individual. But you might talk to the person right next to him and they decide, my bucket list is rather large and I've got a lot of places I want to see across this country. So the spending patterns for those two folks are going to be very, very different, or the income needs are going to be very, very different. Of course, we always encourage our folks to go into retirement debt-free. You look at your home ownership as part of that as well. What's the status of that? Do you rent? Do you have a mortgage? Do you own the home? All those are going to greatly influence your experience in retirement. And then lastly, life can throw us curveballs at the end of the day, right? And all of a sudden we might find out that we have to provide financial support to our parents, our children. Maybe something unfortunate happens and all of a sudden we're raising grandchildren. And that can change the retirement landscape quickly when those sort of things happen. So again, we set the 80 to 85% replacement ratio for educational purposes. Again, they're going to vary individually. I believe our role here at SDRS is to provide the tools, education, and the programs that can help our members determine what their income needs are at the end of the day, starting with that benchmark and then going through that process. So just to give you a little more color on the 80 to 85%, maybe before we talk about this goal, Doug, do you have any other thoughts on this? Pretty straightforward, but
this is kind of the overarching retirement income goal that's going to be broken down into what comes from SDRS, the piece from Social Security that we don't have control of, and then the personal savings piece, which is education. So this is kind of the big one on that, and we're going to break this up into the pieces as we follow.
So we have no recommended changes for this particular goal, other than what Doug pointed out, the income from personal savings, but no other significant changes or anything. Nothing?
I think, well, my thoughts on this, of course, social security is like a mystery. And I think everybody always has that question, well, how much is social security going to be? And I think it's like a moving target. The personal savings, we've thrown out this one-time salary goal all the time, and I think people have gravitated to that. But is it the right number? It may not be for everybody, or it might be a little different. But I don't think people understand what that even means or why you want to save that. But it's really been powerful that it's easy because you message others, save 1 times your salary, and people do that.
Well, it's funny you bring that up because that's one of the goals that we'll have that we'll walk through a little bit is that savings goal. And we'll touch on that.
And the other thing is I don't think people understand how much it costs them the younger they retire too, on not only lost opportunity to maybe save more money and costs of insurance, although people realize it when they get there and they try to buy health insurance, then all of a sudden they're shocked that they couldn't retire at 55. But that's why I wonder sometimes if we did more education about, if you wanted to leave earlier, you really need to save this much more.
And I think that goes back to your education and communication efforts at the end of the day, recognizing that, everybody's going to have a different desired retirement, a different date. If you're wanting to retire younger, we continue to emphasize the importance of savings, and that's going to change that dynamic a little bit. That's why taking advantage of some of the different modeling tools that are out there, if you participate in the supplemental retirement plan, they have a pretty robust tool that you can take advantage of where you can look at those different dates of retirement, and it'll also break down how much additionally you need to save to achieve that goal. And those sort of things. So taking advantage of all these tools that we offer is going to be instrumental at the end of the day for our members to be successful. Because the earlier retire, more savings you're going to have at the end of the day. Very true.
There's a lot of power in keeping it simple though too.
Mm-hmm.
And that's why you throw out the number, 1-time salary, and people, they grasp that. But then when you start getting into the details, like all these tools, and it kind of just gets into the weeds for some people. It's like, boy, I don't want to do all that. I just want something simple,
Well, it is a little intimidating at the end of the day.
And part of that goes back to our sustainability, right? We've been given a budget that's 6% member, 6% employer contributions. We can't provide enough to just live on SDRS, particularly on early retirement. That's enough. So there needs to be some personal effort in here. There needs to be the personal savings as well to get people to that appropriate income level.
Did you have some?
Yes, I just was going to make a comment. One of the things that we do in the county level, we have over 100 employees. What we have really stressed is to get them involved in the supplemental retirement. And in doing that, we contribute to that as well. And I wish every employee would get involved with that, but it keeps a few more every year. But it's an opportunity if you're working for an entity that does not participate in that, mention that to them. We as a county use it as a recruiting tool, as a negotiating item. And it's if the employee, contributes so much, we don't match it, but I mean, we have a regulated scale, so they'll know exactly how much we're contributing according to what they contribute. But it's a good way to get them started in saving, just plain and simple, learning how to save.
There's a lot of opportunities there that employers should look at. I know at our school, we've done, when they get so much leave, instead of paying cash for that, we put it in a supplemental retirement for them. And it's a good start because then they can see that money goes into a mutual fund and starts growing. It actually encourages them to put more in. But I think, and it saves us taxes, payroll taxes by putting those bonuses into those things. I think there's a lot of opportunity for employers to encourage their people to get into supplemental, which we aren't exploring.
Well, and I know, Alan in the communications department, Michelle Human and her team, I mean, again, constantly emphasizing the importance of savings. using the supplemental retirement plan vehicle at the end of the day. With our public schools, and we'll talk about this in a couple of slides when we look at the additional savings goal, but some of our public school employees might take advantage of the 403Bs, the 403B market as well, because they get inundated with a lot of providers at the schools. And then of course we've got certain individuals that, of course, I'm always biased to the SRP because we fight for low costs and those sort of things. I think we have at the end of the day. But I know a number of individuals that may work with their personal financial planner. And it's wherever you have that confidence, as long as you're saving at the end of the day, that's the goal. Of course, I'd like to see everybody take advantage of the SRP as well, Myron, but there are other vehicles that some people take advantage of as well. And again, as long as they're understanding the importance of that additional savings and they're saving somewhere, they're meeting that goal at the end of the day, and that's what we're happy about. We'll continue to advocate and push for the SRP, no doubt.
The SRP, they have that auto enrollment program, right? And we don't have everybody on it. What's the purpose of that? Like, why haven't, what is the reason why people aren't signing up? Would you guys know that?
Yeah, again, it kind of goes back to, forcing budget onto our employers at the end of the day. With the SRP, we want to give them the opportunity to adopt that if they so choose, with that automatic enrollment and also the auto escalation, at least in my view. That had to come down from an employer perspective rather than us just forcing all employers to necessarily do that. Back when it was introduced and adopted, state automatically adopted it and Board of Regents and that sort of thing. But our individual employers out there, they just have to adopt a resolution to bring that in. It is a good vehicle. Probably the one downside to it is, and this is the only negative in my view, sometimes people maybe get that confused with SDRS, and so they see both these contributions coming out. They just think it's SDRS. They don't manage the SRP like maybe they should. Now, again, that comes down to us and making sure that we educate and promote additional savings and those sort of things. But sometimes people don't take full advantage of increasing those contributions. But that was kind of the idea behind it, is not forcing that on our employers, strongly encouraging and advocating for it, but letting that be kind of a local decision if you want to go into that auto enrollment and auto escalation. If that makes sense, Jake.
It becomes complicated on a local level when you're dealing with different collective bargaining units, especially with schools, and
absolutely.
And then their members are saying, "Well, we don't get paid enough already, and now you're going to take $12.50," which they can opt out of it, but education is important there, I think. And
absolutely.
Yeah, it just becomes real complicated when you got all the different collective bargaining groups that you're dealing with.
Great questions. Good feedback. If nothing else, we'll move to the next goal, and that's the retirement income from SDRS. And again, long-term goal of SDRS was, for our career members to receive at least 50% of their final average compensation, and that's career members. And so when we look at our career, that's defined by the different member classes. When you look at Class A, that's a 30-year career. Class B, public safety, it's a 25-year career. Judicial, 20-year career. Obviously, with our members that have maybe shorter careers in public employment, they're expected to receive proportionally less in benefits. I don't think there would be that expectation for us to provide a full career's benefits if they only worked a partial career in public employment in South Dakota. So I don't believe that expectation is there. Also recognizing that they would have retirement benefits from, their prior working career, or their journey that they had before, whether that was maybe in the private sector or the public sector in Nebraska. So when you look at our current provisions that drive our outcomes, of course, you guys are familiar with this. We use a benefit formula, and that's based on your years of service, multiplied times a benefit multiplier, then ultimately multiplied times your years of service. For our Class A foundation members, their multiplier is a little higher for service that's before 2008. Of course, we have formulas that differ by member class, our Class A, Class B public safety, Class B judicial, and of course there's different contribution rates to support those formulas for those different classes as well. And then there's also differences between our foundation and generational members. With that, I'm going to jump to the next slide. Unless there's something you wanted to point out on this slide, Doug, please
Yeah,
do.
yeah, just to make sure. So our goal is 50% for career members. And you see the different career length definitions. And then what's in parentheses is just that 50% divided by those number of years. It's not our current multiplier. It is the multiplier that would effectively get us to that 50%. As we know, Class A, it's either 1.7 for service before 2008 and 1.55 after. So we just wanted to say, okay, because we're going to do some comparisons, that's where the comparison line is at.
Had a long discussion about that 50% number there. And we used to just say the 85 or 80% and all the way through. And then the Social Security piece was always such an unknown, and we settled on having this number in there because we don't know the Social Security, and it's going to be different for everybody. But we even talked a lot about the 80-85% when we went through these goals, I don't know, probably 10 years ago now, but and what's right. And then a lot of that's a personal decision on when you already discussed that, whether or not you're going to be traveling a lot or just going to be sitting working in the garden at home or something. You know, there's a difference in what people need. But in the end, we settled on these numbers after a lot of discussion. I remember that.
With the phrase "at least" before, right? I think we had some discussion of should that be 55 even as well. And this is 5 years ago, we came back to, no, we need to keep it. 55 might be unattainable with our sustainability goal as well, but we want them to have at least 55 or at least 50. I'm sorry.
I argued about the 80-85. Some people wanted it to be 100, that we should have a 100% goal in there. And in the end, we settled on that number. But yeah, it's wide open. There's a lot of discussion. Wes?
What data, you've got lots of data, what data do we have on the average age or median age, service length of our foundation members retiring? And if you don't have it, it's fine. It's something that would factor into here because 30 years, maybe a person can't get to 30 years and maybe the few do. Or maybe a majority do. I don't know the answer.
Right.
But so, I do think it's relevant in terms of a goal. And then public safety as well, judicial not. That is a little bit outside the norm of what I'm asking here.
Right.
And so I'm not asking you to answer that specifically. But I think it's a relevant point in terms of where we should be, or what is the service length of persons who now retire from our system, particularly the foundation people.
Right. December, we usually update those numbers. And if I'm recalling, the median service for our Class A retirees was 22 years, I'm remembering, or 23 years. Our average higher age for our active population is 33 or 34. I think its average age is 44 with 11 years of service. Right. So our active members can get to a 30-year career. But in terms of the goal, though, if somebody's only going to stay 20 years, which might be the median, or 22 years, we can't provide a full career's worth of benefit. And that's not our goal, nor should it be. Right. So as part of what we're asking the board here, and we will in a little bit here, is the 30-year for Class A is that still the appropriate career length? And do we like this 50% goal for a 30-year career? Are those goals appropriate? We can't take care of a 5 or 10 or 20-year member and provide a career's worth of benefits.
This is a question, if I might pursue this, a question of its relevance. Is there any relevance for service that's continuous, or where there's a break in service, or somebody comes in at age 30 and leaves the system, comes back at age 40? Is that relevant to our analysis?
I don't know.
I don't know. I mean,
Yeah, I don't think we'd have if their total service is 30 years, I think the goal would be, let's provide 50% of their final compensation as a benefit, whether it's the last 30 years or 10 of those years were early, or even if it was you work 30 years and then you leave, we would give you, as a terminated vested, if you're not eligible to retire, we would increase that with the COLA until you are eligible. So I think in terms of the goal, we should be thinking of, I guess the two questions are, is the career length right? That 30 years. I've got a sense maybe it could be longer, right? If somebody's entering the workforce at 25, but our goal is a 30-year career, we should be providing a 50% benefit, but it's to the board to discuss here to whether that's appropriate.
okay, one tangent off ramp here on this line of thinking is on the improvement factor relative to those persons who terminate employment and therefore, let's say they're 50 years of age and whatever. And what does the improvement factor cost us in the totality of things versus the improvement factor for COLA, rather, I'm gonna call it, for those who retired and are at the normal retirement age, which has always struck me as being something that has to have a cost, and I don't know if it's material or not.
Don't have that answer readily available. We will talk about the cost of the COLA in the next presentation. But I would have to do some extra work to split it on that. But let's talk about how we got to that, right? We had, back in the history, I think it was the Board of Regents, right, was trying to separate from the plan. And one of their concerns was the treatment of short-term visiting professors. And so that's how we got to having the portable, the enhanced refund that you get a portion of the employer funds if you leave. And the other part of that was applying the COLA to terminated vested benefits so that those people don't lose out on a final career average pay plan by only being here for a few years, right? That they would get a benefit that is as if they worked a portion of a full career here rather than getting a benefit that's based on 30-year-old pay or 20-year-old pay when you do start drawing benefits. That was put in for a specific purpose, to take care of, to treat the short-term people equitably. But as far as the cost number, I'd have to dig into what that costs on our terminated vested. I don't think it's a big portion of the COLA, but I'd have to go dig on that.
And I talk about a career length. You can't really expect to take payouts in retirement for longer than you've worked. And, you know, if you're shortening up that years, I mean, 30, 35 year, people's careers anymore should be 35, almost 40 years if you're going to work from the time you're young until about retirement age. And you're going to be collecting on that for another 30 years. It's pretty hard to fund that long of a retirement on a 20-year or 25-year career. I mean, it's not logical. So if you only worked here 25 years, well, then your other career evidently should have been contributing to retirement too. You should have been saving there. So you would actually, if everything's working right, they should have our retirement and another one if this is second career, which we're seeing a lot of that. People starting in their mid to late 30s. Yeah, I mean, you start looking at like used to use the rule of 85. Yeah. Well, really anymore, almost should have been rule 95 to be a fully funded, comfortable retirement. And yeah, I know, but it put a strain on.
You're gonna get voted off the island.
I know, but it is illogical to say I can save for 20 years at the rate that we're saving and figure I'm gonna get 40 years of return out of that, unless you're gonna save a lot more.
Yeah. Do Do you see a lot of people that retire, let's say with the rule of 85, coming back into the system and working again within the public sector?
Yeah, and
That's kind of.
Yeah, and that's why we spent time on the retirement reemployment provisions that we have over the last, well, ever since I've been here, it seems like retirement reemployment's been a topic of conversation, but we used to see a lot of folks that, prior to us changing our provisions, as soon as they hit that rule of, they used to call it the Friday, Monday thing because you didn't even clean out your office. You left on a Friday, had a nice weekend, came back to work on Monday and increased your pay during your working years on the benefits that you're earning from the system, which is why we have the provisions that we do on that side of it. So we do see a number of our folks that come back to public employment. I think when we, and I don't have any numbers in front of me, maybe Doug does, but when we opened up the part-time side of it as well, being able to work up to 1,250 hours, I think that's benefited a lot of employers at the end of the day, and it kind of helps some of our members, like say, for example, a Jackie in our office. Maybe you want to transition slowly to retirement, right? And you can help out at your organization still from a succession planning perspective, and as well as maybe, in our case, special projects that seem to get put on the back burner sometimes. So I think the 1250 helped out quite a bit as well, and we do see a number of folks that come back to public employment. Absolutely.
There's got to be quite a few people though that are at the rule of 85 though that are still working, correct? Probably for our insurance mostly.
Absolutely.
Right.
We're seeing a lot of people delay their retirements, and the cost of insurance is probably the number one reason. I would say maybe the second reason as of currently, when you look at salary policy a few years ago, when we saw some pretty significant increases in pay. I think some of it was to be more competitive, maybe with the private sector and those sort of things, but some of it was inflation based as well. We have a lot of people that are maybe kicking that can of retirement down the road a little bit because they want to, with our 5-year final average compensation and the caps that are in place, they want to be able to take full advantage of that pay increase that they saw. And so we're seeing people delay retirements for that reason. So the rule of 85 is kind of maybe a trigger point for people to start kind of thinking about it. Realistically, when you're on the younger side of that rule of 85, you're probably not going to retire because, again, it kind of goes back to the total retirement income. And maybe I don't have the personal savings because I know I'm not eligible for Social Security yet, and I don't have the personal savings to make up the difference. The rule of 85 seems like a novel idea, but for a lot of people, it's maybe not realistic either.
And in December's, at the December meeting, we always look at the median retirement age, and it is, teachers are still around 62. All our other class age members, the median retirement age is 65. So there will be some of the people that leave as soon as they're eligible. I don't think you can fund retirement on your own at 55 just with SDRS. You can't take Social Security till 62. So it might be that you're changing careers and going to another job, or you've got a business that's supplying some extra income as well. It's there. We were seeing fewer and fewer members taking advantage of it, which is part of when we designed the generational design. We don't have the subsidized early retirement. It's more equitable. We think you take pretty much an actual reduction. You get the same value if you can take it early, but the reduction is such that you get the same value as taking it at your normal retirement age.
On the equity issues is you favor one group over another group really with the rules of 85, and on the generational system, we try to make it more equitable for everyone.
Some slides coming up. When you look at it, you take out Social Security, you're not reaching your 85%. I mean, you're taking a 29 to 34% hit. And so, with personal savings in there to get towards that number, it's almost impossible to reach it at that without picking up a different income. And, the teachers I see around me, some of them go an extra year or an extra 2 years, but then they're like, yeah, I can't do this anymore. And then they're going and working at a store here, a store there, but they're just burned out teaching. But that's what you're seeing a lot of. If they're leaving, they're going to, just to equal out what they were making or make a little bit ahead of what they were making when you take in South Dakota retirement early. So they're still going out there working. They're just not getting a pension just to cover. So, but in the long run, it's going to actually might bite them a little bit because they're not adding more money into their accounts. So
Maybe we'll jump to the next slide. We've kind of tackled some of this at this point, but I think it's important to note that, when we look at our retirement income for SDRS and kind of our observations and our issues, Class A foundation members are the only ones that show a slight shortfall. And so they aren't meeting that 50% goal. And really, if they do, it depends heavily on how much service they had that occurred before 2008. We have a couple of examples up on the slide that kind of give you an idea of a range of where that income replacement would land, depending on that pre-2008 service mix. And so when you look at that first line, where you had somebody that earned their entire career entirely after 2008, that 30-year full career for a Class A foundation member, they're going to get to about 46.5% of final average compensation. So they're at about 93% of that 50% goal. If you look at the mix that they would have, maybe throw in a little bit of that pre-2008 into the mix. So they have 18 years of service after 08, 12 before. So they have that blended formula. They're at about 48.3% of final average compensation. So again, a little shy of that 50% goal. They're about 96.6%. So for our Class A members, they're the only group, foundation members, I should say, Class A foundation are the only group that show a slight shortfall. And really, for them to achieve that 50% goal, they're probably going to have to work about 1.25 years to 2.25 years longer. And again, that'll depend on their pre-2008 mix at the end of the day. When you look at the other groups, when you look at our Class B foundation members, as well as all of the membership in the generational design, they're all meeting that goal. Now, of course, we don't have any funding to do anything about that at this point. It's a shortfall for our foundation members, our Class A foundation members. We don't have any resources to do anything at this point, but I think we just need to continue the conversation. We'll do so here in a couple of slides. I want to give Doug an opportunity I think he's got a couple of bubble charts to cover here, and then we can kind of get into more conversation on this.
Yeah. And what we're trying to show here, and from the screens, the print's too small again, note for the next one, right? We were trying to show how are our current retirees doing compared to that 50% income from SDRS over a 30-year career. These are our Class A current retirees. And for all the members before 2008, they're at a 1.7% multiplier. And if our 30-year multiplier is 1.67, that gets us to the 50%. Most of them are around 102%. There's a little noise in here. Otherwise, those should be mostly at 102%. For our folks that have some of the service after 2008, they're at about 100.5% of the goal. When we get to the last two groups, those that retired after 2016 and those after 2023, they're starting to drift down below that 100% line. Now, the size of the group is relative to the number of people in that grouping that have Class A service. So, like 10,400 people of our current retirees were Class A members and had retired between 2016 and 2022. If we think about where this is going to roll out, as Travis said just on the last slide, this is eventually going to trend down to 93%. So the bulk, most of our retirees at this point are at this goal. We have the recent retirees that are starting to drift below this goal. I should have said at the beginning, we're grouping these members based on their fiscal year of retirement, and there's a reason why we did it this way that's going to be apparent later on when we get to talking about the COLA as well. When we look at our public safety retirees, Well, right now they have this is foundation folks, really, because just about all of our retirees are foundation retirees now. I think we have 1% of our retirees that are generational members. Public safety members have the 2% multiplier, so that's equivalent to our 50% goal for a 25-year career. Their improved benefit was at 2.4%. Right, so a lot of those retirees exceeded our 50% for a 25-year career as well. So our public safety members compared to this goal look pretty well taken care of. We're going to come back to these charts and combine them with some other things here later on, which is why we did it in that fashion. Just you.
So on this slide here, again, if we look at the assessment, again, I think we're at the end of the day, we're generally meeting our goal. But again, our Class A foundation members are the only group that show a slight shortfall. We already kind of started conversation on the key question. That was going to be a part of the discussion here towards the end of the slide, but we already kind of started it. And it was really whether that current definition of career was still appropriate at the end of the day, looking at the 30 years for Class A, 25 for Class B public safety, and 20 for judicial. You know, kind of going back to Wes's comment, you know, if you're questioning whether the 30-year career is right, then you go, you know, towards that direction of 25 for Class A members. That's and our goal is still 50%. That's a significant increase to the multiplier at the end of the day. And our contribution structure that we have in place today doesn't even come close to supporting that. Again, we're not even meeting it currently for the foundation members. And so, again, is the 30-year career for Class A, 25 public safety, 20 for judicial, are those appropriate for evaluating benefit adequacy? Because at the end of the day, they really drive our outcomes for the 50% final average compensation adequacy goal at the end of the day. So we don't have any recommended changes. Doug and I don't currently. I think this is more of kind of a discussion point. We can continue these discussions as we move on. I don't think we have to make a final decision today, but certainly would like more feedback on some of this from some of you if you have it. And Doug, if you have anything else you want to add, if I missed anything, you look like you had something.
Well, just like the two key questions are 50% for a career. Is that the appropriate goal from SDRS? And we're going to put that pieces with Social Security later on here today. And then the career lengths, because those are the two variables we're really talking about here.
And when we're thinking about this, of course, the lifetime has to be the, you know, now that people are living longer, we got to look at the average lifespan of how people are living longer. And then you look and, you know, read an article yesterday on Social Security, you know, 3-4 years ago, it was, they're saying at 2035, it's supposed to take a cut. And now they've moved it to 2032. They're figuring it's going to be about a $500 cut if, you know, Congress doesn't do anything. And, you know, you take a look at Social Security in this and you're taking a look at the longevity, you know, you're talking about those years. Do we need to move that target a little bit? You know, technically that might be the answer to part of this, is to move that target longer for people working. And I hate to say that, you know, I'm at that age where, do I really want to work much longer? And, you know, you look at that, but the answer is, you know, for sustainability, the answer is probably, yeah, you're going to have to move the target sometime, especially with Social Security looking what it's looking like unless something is done. And of course, Congress won't do anything until they get to the very end. We know that because they don't want to get knocked out. But it's going to be a kind of one of those issues where we may have to, you know, take a really good look at this in, you know, 5-6 years. It's going to really, that target's going to have to move, I'm assuming.
I think the current federal law would say Social Security benefits reduced by 22%, in that neighborhood, 22-23%, which would on average equate to that 500. Now, we'll note that, but we can't do anything about it, right? But we're going to factor in how the benefits are right now into our whole analysis here.
Philosophically, if you want to maintain that 85%, say and Social Security is going down, then you're gonna have to increase benefits, which means more contributions. That's the only way you could do it. And I don't think there's any appetite out there right now to increase contributions, but in reality, if you don't want to change the career lengths and you want to maintain that level of income, that's the only real alternative that there is.
Yeah, and I was just gonna say, I think it
Well-
comes down to your personal savings as a system. I mean, there's no appetite for contribution
Yeah.
increases. I mean, you know, we've heard how budgets are tight and those sort of things. I can't imagine how you'd eat that. So we'd have no way to afford increased benefits without those increased contributions. So going back to your individual planning, it's gonna come down to personal savings and
Which is-
taking advantage of the SRP and those sort of things to make up for whatever happens with Social Security, if that does happen and they don't act and make those changes.
In effect, that's the same thing. If your employer is not going to contribute more than you are,
That's right.
or you're going to change something else in your planning, something has to give.
Well, this was really good discussion on this one. This is what Doug and I were hopeful for. I don't know if there's any other thoughts. We weren't necessarily, again, recommending any sort of changes. I think this is a discussion that we need to continue to have moving forward. I think our goal is probably appropriate. Right now, again, we don't have the resources to do anything there for our Class A foundation member shortfall. But again, we have our contingency plan where we'll talk about later with the COLA, but they've always been a part of our plans for if we were in a position to make benefit improvements, and this class is probably one of those as well to consider. Doug, do you have additional thoughts? You look like you do.
Well, we are going to talk about personal savings, and then we're going to put the pieces together and talk about that 80 to 85% goal. And certainly, if we move on from this, this is not closing this discussion on this piece. We can come back to it after we look at the pieces all together here as well.
For the people that haven't been on the board a long time, this is a philosophical discussion we have probably every 5 to 10 years or in between there. And it's a lot of probably people sitting here haven't been through before.
Absolutely.
But, and that's why we bring it up, because we want to see if any of the ideas have changed, and then also to inform where these things came from in the first place and why we set these goals. But yeah, we've had some long drag out discussions about these things in the past, if you've been around long enough.
Maybe we'll, you want to break for lunch now? We've got quite a bit to cover yet. So some of the later goals are a little more straightforward and easier to cover, but I know Doug's got a pretty thorough spendable income analysis, and that might take a little bit to get through those slides. So we also have our additional savings that we want to talk about next. Do you want to take a quick 30-minute lunch, come back at 12:45, or what's everybody's thought? Does that make sense? All right. We'll be back at 12:45 then.
Yep,
Yeah.
let's do 12. Okay,
I think we're on to.
okay, we need to get back to business, I guess. So
Yep.
everybody want to take a seat?
Good job. Had a teacher back in the day used to use it.
All right, you ready to go? Doug's trying to figure out where to pick back up, I think. So who?
Well, I think we can move on to the next goal. We had good discussion, not that we can't circle back around to that last goal that we just talked about with the 50% income replacement and career service and all that discussion we had. It was really good. We can always come back to that a little bit more, but we need to keep this thing moving along. So we're going to jump into the additional member savings. And actually, Mr. Chair, you kind of alluded to that a little bit ago in one of the slides, talking about that long-term goal that we have as a system. And it's really educating and encouraging our members to accumulate a personal savings equal to at least 100% of annual pay by the time they retire. I almost feel like there should be like bolded and underlined at least, because it may take much more than that to be successful in retirement. But that's kind of, again, a benchmark, something that we kind of set as that benchmark for people to say. I think what this goal does, it really recognizes that the SDRS benefits are designed to be a major piece of the retirement income replacement, but not the only piece at the end of the day. And so as far as how we're doing, I think from an educational perspective, we're consistently meeting the goal. Again, when you look at our counseling sessions, our resources, planning resources, communication materials, we all reinforce the importance of additional savings. And of course, our efforts are going to continue to be ongoing and evolve. So we have a couple of vehicles. We already talked about them before, the supplemental retirement plan, the special pay plan. That's what we have in place for saving those additional dollars. I don't think we need to talk about those again. We're familiar with those. Those are two vehicles that folks can use. We talked about it a little bit ago as well, that people may utilize other vehicles to get to that goal for their personal savings, whether if you're with public schools, maybe it's a 403B, maybe if you're working with a personal financial advisor, you might be taking advantage of other vehicles as well to enhance that savings. So at the end of the day, I think we've got the educational structural components there to be successful or have our members be successful. It's kind of that old saying, though, you can lead a horse to water, but you can't make them drink. So we can provide them with these tools, but in education, those sort of things, but we really got to keep trying to push them to take advantage of those sort of things. So we have no recommended changes, I don't believe, on this goal here. But Doug, if there's anything you want to add or anybody else want to chime in, again, it's at least 100%
Yeah,
of
and
that pay.
right, and based on, and at the bottom of this page, right, based on the career lengths, that's the, and just some assumptions about earnings and salary increases, that's the approximate percentage each of these classes would need to put in to accumulate to that 100% of pay. So in some of the exhibits coming up on their spendable income analysis, that's what we're using as how much you're contributing during your career.
Have we ever thought about increasing the minimum for the supplemental retirement auto enrollment? It's been $12.50, I think, for as long as I can remember. And I mean, that's a cup of coffee anymore. Yeah. So, I mean, has there ever been thought about maybe starting it a little higher?
You know, we haven't had much discussion on that. I do remember even back when we implemented it, even today with some of our folks, we get criticized sometimes about the $12.50, especially with all the wage, differences that you have. You have folks on the lower end of the wage scale. That $12.50 a paycheck or $25 a month might be somewhat significant to them. So we always figure that with our educational side of it, that people can take that contribution and increase it if they need to. We just kind of wanted to get in the door. And I think that's the trickiest part, is recognizing the pay differences of folks. And for some of us, maybe it makes sense to start out at 50 or 100 and that sort of thing, and we can absorb that with our pay. But some folks on maybe the lower end of the wage scale, that could be a little more challenging. So that's probably why we haven't considered going any further and just continuing to educate and the importance of savings, if that answers your question, if that's a fair answer. Yeah.
One other comment on that. Are there a lot of people that are opt out of that?
Our opt-out is still very low on the auto enrollment. I think, Doug, is it around 5% or?
I had
3?
it at 8 in my mind.
Yeah, so I don't remember the exact number, somewhere between 5 and 8, I'd say, but I was thinking it's closer to the 5. Is that right? Okay, Michelle Michelson's telling me 5%.
Yeah.
That's and so very low opt-out, but once again, I would also emphasize that sometimes we maybe don't see a lot of activity with people increasing contributions either. Maybe taking advantage of the education that we put out there, and it might stay at the $12.50 that we were just talking about per pay period, or $25 a month for a long time. They just don't do anything else with it unless the employer has the auto escalation feature, which is still pretty minimal at the end of the day. But again, opt out is very low, 5%. And that's since the inception of it, which is pretty remarkable, actually. Yeah.
Of those employers that have auto escalation, do a lot of people opt out of that?
Yeah, I would have to go back and talk to the SRP on the auto escalation. Now, technically, what happens, I think, and I'm looking for guidance on this, if I remember, you can change your amount that you want to have taken out of your check, but that auto escalation always applies to that person because it's based on your hire date. And so that I think of my wife as an example, just based on when she was hired with a new employer, she's always an auto escalation employee now. So even if she goes in and adjusts it, that next year it's going to do the escalation too. So that sticks with that person because of their enrollment, that sort of thing. And everybody's shaking their heads yes. So I'm not even making any of this up. That's pretty good. Pretty happy about that. But anyway, that was my recollection. But no, so we don't typically see that. Some people will just go in and manage their overall contributions, maybe to increase that further, but they're still auto escalation at the end of the day.
And Travis, just to pick at something Paul always would, but right, those are all defined as dollar amounts still in our system, not as a percent of pay. And a lot of other, I think on the private sector, you would define your contribution as a percent of pay, and then it would kind of automatically go up with your salary as well. We don't have that.
Which is one of the discussions that we've had, which may, lead to more discussion with you down the road. Now that the state is, looking at a new counting system and those sort of things, that might open up the door for going to percentages rather than fixed dollar amounts. Because as Doug said, when you do the percentage of pay, that auto escalation is already built in there. And that was one of the things that we didn't have in the past. And so this might open up a door for some other things. Probably more discussion to come at this point. We're not ready for that yet because state's still working on some of their things anyway, but that door could open up in the future. It's something that we've always been really interested in, to be honest with you, is doing that. Anything else on the additional member savings? If not, I know Doug's got the next several slides to cover the spendable income analysis, which is really good. And so if not, I'll turn it to Doug for that.
Thanks. And we're going to try and now put together the piece from SDRS with personal savings and Social Security and show you how we got to this 80 to 85% range, and then assess how our members are doing compared to that goal. Excuse me. At the end of that first paragraph, really our goal is that our career members are able to maintain their standard of living in retirement. So what we're going for here is we pre-retirement look at your spendable income, which is your gross minus your SDRS contributions, your Social Security contributions, Medicare contributions or taxes, less your taxes, right? And we compare it to your retirement income, where you don't have to make those SDRS or Social Security contributions, but you do have taxes, albeit on a slightly different basis. We're hoping to get, we're trying to look at what do you need as a gross amount that'll get you to the same spendable amount, right? So if your expenses stay level, then you're able to maintain your standard of living in retirement. We're trying to avoid saying, well, my take home now is $5,000 a month. If I get gross retirement income of $5,000 a month, we're good. No, we need to look at what comes after those contributions and taxes as well. So this is we're going to walk through one example in detail and then look at different classes of people at different compensation levels. So if we look at the before retirement side, and we've got a Class A foundation member who's making $76,000 a year. That's his final average compensation. That's the median pay for our Class A foundation members who are over age 50 with 25 years of service. So our group that's nearing retirement, right? So you have your final average pay. The STRS contributions, we're subtracting off 6% of that. I should have said the middle column here, or the left-hand column, is if you don't have the personal savings. The right-hand column is if you're making enough personal savings or putting away enough to get to that 100% of pay saved at retirement. So you have your final average compensation, less your STRS contributions, less 7.65%, that is the combined Social Security and Medicare taxes. On the left-hand side, that gives us $65,600 net income, minus taxes of about $7,000 gets us to $58,700. On the right-hand side, if you're putting away that just over 2%, that'll get you to 100% of pay saved at retirement. You're living on a little less pre-retirement, right? So you're living on $64,000, after taxes about $57,500. So that's what we would need to replace with retirement income if they're able to maintain their standard of living in retirement. So if we take the same person again without and with savings, and we look at retirement, we're doing a Class A member retiring with 30 years of service at age 65. This is a 2026 retiree. So he's got 18 years after 2008 at the 1.55, 12 years before 2008 at the 1.7%, right? So your STRS benefit then is 48.3% of that final average salary. You've got a Social Security benefit that we're taking at age 65. So it's not your full primary insurance amount. It's 86 2/3% of that. We take the reduction to age 65. On the left-hand side, that gives us a gross retirement income of $59,000. On the right-hand side, if you had the personal savings, we're converting that final pay to an annuity using the supplemental pension benefit rates, right? Which is available to all our members. You can buy an annuity, an additional annuity from STRS through that. That would get that with the savings up to a gross retirement of $63,000. So then we're doing the tax calculation, and we're actually plugging in standard deduction, the age 65 deduction in the post-retirement, and then applying the tax brackets. We did not apply here the temporary extra $6,000 deduction. That's I think it's stated in law just for a couple of years right now. That's a new thing. We left that out of this because of its temporary nature, what appears to be temporary right now. So on the left-hand side, if you do not have personal savings, your spendable income of $54,800 means you have a drop in what you're taking home of about 6.7%. But if you do have the personal savings, your income's actually, your spendable income's going up by 2%. Right, so this is what we're gonna walk through this for different compensation ranges. At the bottom here, for again, this is our Class A foundation members. At the low end of pay, you have where Social Security is going to provide a bigger percent of pay benefit. At the low end, if you don't have savings, your spendable income is going to go down just over 2%. But if you have that personal savings, you're going to have a 6.5% income increase in what you have as a spendable income. At the higher ranges of pay, and that's the 90th percentile, the 122,000, you have a sizable decrease if you don't have the personal savings, and a very small, less than a 1% decrease in spendable income if you do have the personal savings. So this is the process we're going through. That is going to hopefully get us to this, show you how we got to this 80-85 range. We're going to include STRS, Social Security, personal savings, people meeting the career service definition that retire at normal retirement age. Our foundation members, we're going to consider retirement in 2026, which just determines how much of your service is improved or not. And that you have 100% of pay at retirement set aside, and you commence Social Security benefits either when you retire or for public safety members at age 62 as early as you can. Okay. So this was all really to lay the groundwork. For these charts, what we're looking at. So this is a Class A foundation member, works 30 years, retires at 65. We've got 5 really compensation bands that we're looking at, which are for that group of people nearing retirement, the 10th, 25th, 50th, 75th, and 90th percentile. For all these folks, STRS is going to replace, if you retire in 2026, again, 48.3% of pay. Social Security, you see the range that it's going to provide. Starts out at 34% for our low paid people, down to 25 or 26% for our higher paid people. It's a progressive formula, provides a bigger percent of salary for our lower paid people. The green slice there is 5.65% of pay. So if we have 1 times pay, if you have your final pay saved at retirement and you use the supplemental pension benefit to provide another annuity from STRS, that'll be about 5.7% of your final average salary. So in that left-hand column, we're saying that those 3 sources would provide 87.7% of the final average salary. And then the line is what you would need if we go through that spendable income, and your spendable income post-retirement is exactly equal to your spendable income pre-retirement. So that says for this member, for our low-paid people, our low-paid Class A foundation members, retire 30 years of service, you should have an increase in your take-home pay when you retire. As we go up with the compensation levels, for the first 4, our lowest 75% earners, right? They are all, if they meet these criteria, 30 years, put 100% of pay away, are participating in Social Security, you should be taking home more in spendable income than you had during your career. Our highest paid people, you might have to save a smidgen more, right? A little bit more to reach that, to be able to have that same income coming in after retirement. So is this making any sense to people as we go through it, right? This is how we got to this 80 to 85% goal. 80% looks like it would work for most of our Class A foundation people. Our high paid people would need a little bit more than the 80%.
I might add that to substantiate your numbers, the average compensation for teachers is not much different than what you have for your $75,000 number. In fact, I'm trying to find the data, and I haven't found it yet. But your numbers in terms of the 76,000 number isn't far off of what's practical out there in our universe, particularly in K-12 teachers, and of course it would go down if you divide it by 2,080 hours, what that is per hour for county workers and other persons in that pay range or classification. Your numbers do not misrepresent reality.
Right. And this is, we were looking at a subgroup here too. We were looking at people as they approach retirement eligibility here, right? Those are 50 plus, right? So it did, at first glance, it seemed a little bit high to me, but it is, you got to be 50 plus with 25 years of service is what we're looking at for these folks. Proceed. So if we take our Class A members and then look at our generational members. Now we've got retirement at age 67 for these folks. That's when our normal retirement age is set at. A higher multiplier. So STRS would provide 54% of pay for our 30-year career definition members. That purple line in the middle is the VRA. So if we model 1.5% going into the VRA account each year with our assumed investment return and convert that to an SPB through the SPB to an annuity at retirement, that provides 4.2% of final average pay. Social Security, you're going to see a little bit higher percentage across the board here, because if we're assuming retirement at age 67, well, for most folks, that's going to be Social Security normal retirement age. So you do get 100% of the PIA at that point. And then the personal savings is the green slice at the top, and it provides a little bit higher percentage because we're taking that at age 67. So if you have 100% of pay converted at a little later age, you get a little bit bigger annuity as well. So what we're showing here is that for our generational folks, and Alan, you were just saying this to me in the break, right? If your generational folks work 30 years for us and retire at 67, they're going to be pretty well taken care of, able to maintain their standard of living retirement. Couple things that we don't have in the generational design. One is the automatic 60% survivor protection, right? And the other is subsidized early. So having more than the required income to maintain that standard of living says, well, you might be able to go a little bit earlier, take a little bit reduction, fund some of that through the VRA or other savings. The other is you could take your STRS benefit as a joint survivor with a little reduced benefit. And age 67, you get about 91.5% of that benefit if your spouse is the same age. But even if we convert all the STRS pieces to a joint and 60% survivor, even at our highest compensation range, the generational folks look like we are providing the opportunity for them to have an increase in spendable income if they work a career with us as well. Make sense so far? Okay to keep proceeding? Okay. Public safety and public safety foundation folks. Now we're doing retirement here at age 55. Right. The STRS percentage here again considers 18 years after 2008. So that results in 7 years before 2008. So that's 52.8% of final average compensation from STRS. You'll see we've tried to shade the Social Security because the Social Security benefit available here is at age 62, and we're assuming retirement at age 55. They're not able to take that Social Security till 62. So even though we're modeling here what their percentage would be from Social Security, there is that gap there between 55 and 62 that our public safety members would have to fill through savings, through other employment, through some sort of bridge to get them to that normal retirement age. We talked about this. Our foundation folks have available a Social Security level income where you could take a higher STRS benefit early and a lower STRS benefit later to kind of equalize your total income from STRS and Social Security. We don't promote that because it leads to some bad decisions, right? People front load your retirement then, and it puts a strain on the later years. So except for that gap, and we recognize that there is this gap that the Social Security won't be available, all of our foundation public safety members, when we run through this analysis, they're able, if they meet their career goal, have 100% of pay put away in a savings, you're able to have more spendable income in retirement than you did pre-retirement as well. When we look at our public safety generational members, same story with the Social Security as well. They're not able to take that till 62. But when we factor in the pieces from STRS and Social Security, if you worked at 25 years and retire at 57 now for public safety generational folks, you should have more spendable income in retirement than you did pre-retirement, the years right before retirement. And we have two slides with our judicial members, just two groupings because their pay are really in two broad bands. And both of them on the foundation folks look like their spendable income will exceed what they had pre-retirement, and also on the generational folks as well. So when we look at that, right, and we go through the analysis, this is how we got to that 80 to 85% goal, right? That at that level, if you're not making retirement contributions, Social Security contributions, your taxes are going to be a little bit lower because of the extra deduction. You should be able to have the same spendable income. And if you're able to eliminate some debt, maybe keep your expenses the same, you should be able to maintain that standard of living in retirement. Our foundation folks, remember right now, a 2026 retiree has 18 years of unimproved benefits. So we're still going to see some decline in that percentage that SDRS provides, or that you're able to replace. Contingency planning, right? One of the goals in there is that if at some point we meet the board's criteria for benefit improvements, one of the improvements that we've identified is improving the multiplier for service after 2008. There's a couple things in here that kind of point to that. Would be continuing the way we've done that in the past. Might be, I'm getting a lot of echo, you know, might be a way to get us back on a level basis. Sorry, it's really disconcerting to hear yourself a couple seconds later. So I'm going to stop there for a second. Well, one more maybe. This is a starting point, right? And I think our counselors that go out talk to every retiree about, you've got to see what fits for you, right? This is a good starting point. We'll give you the tools, we'll help you plan, but you've got to decide how your retirement's going to go, what type of retirement you want to have. Healthcare costs are going to be a big issue before and after Medicare eligibility, and even in through retirement. We typically see decreases in your spending as you age through retirement, but then healthcare costs start to go up in your later years as well. Comments on this overall goal? Travis, anything to add here? Or?
Oh, I think I pretty much said everything in my preliminary comments with the slide, other than the fact that I really like the spendable analysis that Doug has put together. I think it really puts it all together where we can visually see that. Matter of fact, I liked it so much that, you know, I know we're working right now on our website on the secure portal, and we're creating a website that's even more intuitive and has more tools and those sort of things. And I can see this sort of modeling tool being really advantageous to our members, where maybe they can kind of depict where they want to be, if it's the 85% or if it's 75, is it 100%, and they can plan for their goals and see all that sort of thing. So that was probably one of my biggest takeaways. I still think our 80 to 85%, you know, is that benchmark. And then, you know, got to do self-analysis at the end of the day and see what you want to do in retirement. So I think, again, we've got the tools there, and we continue to enhance those tools to help people be successful. So I don't have any changes, that's for sure, any change recommendations.
On the COLA discussion later, are you going to get into, I mean, then you mentioned it, there was a goal of bringing that 1.7 to the newer members. And also one of our goals was to try to catch people up on the inflation end of it, and how those things kind of interact a little bit. Because if you bring up people to the 1.7 that are retired already, basically they're getting a raise. Is that more beneficial than doing a catch up on the COLAs? I was wondering if you can get into that a little bit more later.
Yeah, we'll get into a little more later. But in last week's investment council meeting, that topic came up, right? During those early years when we had a investment return that was well above what we were assuming for a number of years in a row, instead of the COLA increases, there were benefit improvements. And it was pretty effective to making up for lost COLAs. So we are going to try and put those two pieces together, right? How are we doing on that 50% goal with how are we doing with the COLA, and maybe look at those combined here when we get to the COLA presentation.
We're going to go ahead and skip the COLA slide. Just know that this is the order and the flow that we would recommend to the long-term benefit goals document. This is where the COLA would sit. But again, we separated this presentation so we can take a deeper dive. So let's just jump right into the next.
And we're not skipping this topic. We got 20 pages.
We got
on
20
it later.
pages coming up. Trust me, we will not skip it. I know you guys are awfully excited about all that too. So when we look at normal retirement age, I think at the end of the day, the goal here was just really to provide a unreduced retirement benefit at an age that was appropriate for each membership group. Of course, there's factors that you have to consider. Maybe a couple of those key factors were, the physical demands and the risk associated with Class B public safety. And of course, you have to consider the increasing life expectancy for the overall population at the end of the day. And I think that the overall intent here is just to really balance member needs, occupational realities, and the long-term sustainability. You guys are familiar with our current provision, for our foundation members, Class A and judicial, normal retirement age 65, public safety is 55, for generational, for our judicial and Class A members 67, and for public safety 57. Again, we're meeting the goal. I think our structure meets the objectives of aligning the unreduced retirement benefits with both job demands, life expectancy, and all those other considerations that we take into place. So I think the provisions fit well with our long-term goals. We don't have any recommended changes here. Matter of fact, we spent a lot of time discussing this back when we created the generational design and what that should look like and considering normal retirement age. And so it was very exhausting conversations on a number of these fronts when we were doing that. Doug, I don't know if you want to elaborate on anything. It's pretty straightforward, but if there's anything else I missed, jump in as usual.
I was gonna, but it's on the next slide anyhow, so we'll get to it.
Anything, again, no changes from Doug and I think these are maybe a little more straightforward moving forward. All right. Now looking at the opposite side, looking at early retirement benefits at the end of the day. And again, you kind of have to look at our retirement goals from both, from two lenses, the foundation members and the generational members, because I think there were different goals at the end of the day, because the foundation members was the original design, kind of the legacy design, if you will. And so for the goal for those folks was to have unreduced benefits for those long service members who meet that rule of eligibility. Of course, subsidized reduced benefits for other members, could retire as early as age or 10 years before normal retirement age. That was the early retirement eligibility. When we look at the generational design, that kind of shifted, right? And that's where we kind of looked at those non-subsidized reduced benefits that begin 10 years prior to normal retirement age. And I think at that point, we really recognized that generational members have maybe a higher benefit formula, as well as the VRA that had a increased value for that particular group as well. And I think these goals really balance the fairness, sustainability, and the benefit structures. The current provisions, for our foundation members, I think we're all familiar with this as well. Rule of 85 for Class A, 75 for Class B public safety, Rule of 80 for judicial. Earliest retirement age is 55 for Class A and judicial, 45 for public safety. There's a 3% reduction for each year that you retired prior to normal retirement age and you didn't meet that rule of eligibility. When you look at our generational members, early retirement is available 10 years before normal retirement age, but the benefits are reduced 5% a year, and it's intentionally non-subsidized. When we worked on that design, that was intentional. Again, recognizing increased benefit multipliers in the variable retirement account at the end of the day. So again, I think our current structure is aligning with the overall goals. We would have no recommended changes here. And again, going back to what I said on the prior slide, we spent a lot of time talking about this when we create the generation design at the end of the day. Doug, I know you probably have something to add.
Yeah, one of the criticisms we hear sometimes of the generational is that I can't work till 67, or I can't, for as public safety, work for 57 till 57. there is availability of those benefits 10% or 10 years earlier. So 57 for Class A, 47 for public safety, but you take a reduction that is approximately actuarially neutral, that you're getting the same value of the benefit as if you waited until that normal retirement age. You know, we are acknowledging that not everybody's going to be able to work that long. But in keeping with our goal of not giving ways for members to get more value than the other, it's an actuarially neutral reduction as well.
And no recommended changes here, but certainly if you have any thoughts, share them. None? All right, we'll proceed. The next three slides are really important to the pension plan as well. Not that any of these other goals were not, but these next three goals to me are pretty significant. You know, the first is that disability income, just a real important piece to a plan, you know, recognizing those folks that, you know, maybe experience that disability, especially or maybe even early in their career, right? To provide those benefits on really that lifetime income replacement at the end of the day. And that's the greater of the 25% of the final average compensation or the member's SDRS benefit that they've earned up to that date of disability. And again, it's just that meaningful inflation protection for those folks that may experience a disability. And for some, it may even be a very short career because of that disability. And I think that's just the right thing to do at the end of the day. We spent a lot of time discussing our income replacement from SDRS prior to 2015. We had some reform in 2015. Actually, our old disability benefits for those members that would apply and be approved for disability for both SDRS and Social Security, the benefits that they would receive in the aggregate between the two was over 100% in a lot of cases. And that really wasn't the intent of those two plans working together. We did kind of some rejiggering of what the benefits of SDRS like. Again, that was implemented in 2015. So when you look at the average member now, SDRS member who qualifies for both SDRS disability benefits and Social Security, probably looking at an income replacement of roughly about 70%, almost 70%. So I think it's providing the intended level of security for those, or that protection of income for those particular members. And so it's meeting the goal. We wouldn't have any recommended changes today, but certainly if anybody has any thoughts on that, open to discussion. Proceed. Much like our discussions for disability, prior to 2015, we spent a lot of time on family benefits in particular. Again, when we look at our long-term goals for pre-retirement death benefits, that you really are looking at kind of two components. We have the temporary income replacement for those surviving children. And again, it's very similar to the disability benefits, 25% of FAC, or the earned retirement benefit up to the date of the death is what we have provided that family. And of course, from there, there's the ongoing, once you get beyond the family benefit, there's the ongoing retirement income for the surviving spouse. And that's equal to 60% of the greater of that final average compensation or the member's earned benefit. Again, I think here, it's just ensuring meaningful income protection, which I would argue is probably the most vulnerable financial time in those individuals' lives when you lose that spouse and you still have children to care for. And we want to make sure that we're taking care of those folks. I think our provisions are meeting the goals exactly, maybe even exceeding it in some cases. When you look at the intended level of family protection, when you look at the average SDRS member with 2 eligible children, when you combine those SDRS and Social Security benefits, you're looking at probably nearly 100% of income replacement, which I think you probably need to be near at that level when you're looking at taking care of children at the end of the day. And we want to do the right thing for the family. So again, I think our goals are meeting our provisions, and we would have no recommended changes here. Seeing nothing, so we'll move on. Of course, death after retirement, I promised this last slide talking about death, but these are important benefits to provide to our surviving spouses and our families. And really, again, you almost have to break this out between the foundation members and the generational members when you really look at the goals, because again, the foundation members were kind of that legacy design. That was the original design. And at that time, the goal was to provide that lifetime income benefit equal to 60% of the member's benefit at no cost to the member. Of course, that would have been subsidized at that time by those folks that were single, didn't have that continuation of the benefit. So it was subsidized by those folks that weren't receiving any sort of continued benefit. For our generational members, I think what we did there was we just offered greater flexibility at the end of the day. The member, when they retire, can choose. They do the election of whether they want to provide the lifetime survivor protection of 60 or 100%. And that's funded through an actuarial reduction. I think Doug talked about that a little bit earlier. So of course we would calculate it at kind of that single life annuity, if you will. And then if you want to add on the survivor protection, there's an actuarial cost associated with the 60 or the 100%, whichever direction that you want to go. So again, I think we're meeting the goal. I'm kind of flying through some of these now. We've been talking a long time, but I think these are pretty straightforward. I think our provisions, again, I think they remain effective and are appropriately structured and consistent with our benefit philosophies here at SDRS. So we don't have any changes to recommend here. Again, a lot of discussion on this side of it as well when we put together generational. Any thoughts on that, or we good? Looks like we're good, Doug. We kind of talked about the enhanced portability a little bit ago, didn't we? But of course, it's one of our goals. And that's, again, just that, portability is just to ensure really those equitable benefits for those shorter service members. Our current provisions right now, when you look at our vesting, we have very early vesting here at the South Dakota Retirement System with 3 years. That's maybe a little more inconsistent maybe with what you see in the public sector. You probably see more like 5. Of course, we're at 3. Deferred benefits continue to grow. We talked about that, and Wes kind of expressed his views on some of those things with that salary or with that benefit continuing to grow, why those deferred benefits remain with the system. But really what the enhanced portability does just gives a person the option. If they don't want to defer that benefit into the future, they can alternatively take that lump sum. You'll often hear us refer to it as a refund, and that's where you get 85% of the employer's contributions if you're vested, 50% if you're not vested, of course, 100% of the members' contributions and all the interest associated with that. Again, I think this offers strong flexibility. We're not only meeting this goal, I would say we probably exceed this goal when you compare us to the public pension industry, because most plans don't offer this, and it's actually this level of equity, I should say, for short service members. And it's often a criticism of public pension plans is not recognizing those short service members. So I guess we're kind of unusually strong and superior in this thing. So I think this continues to be a major strength of SDRS, and we have no recommended changes here as well. But Doug, if there's anything you want to add, or anybody else, I think these are pretty straightforward.
Just to Wes's question, I don't have an easy answer to how much that COLA on the deferred vested benefits, and that's something we can dig into and take a look at as well.
On total payments, I think is where we're at now, Doug, very similar to me as far as the enhanced portability. And again, the only difference here is you're really just looking that this goal is to make sure that every member receives that minimum level of total benefits from SDRS, regardless of when they terminate employment. Again, it kind of goes back to that refund side of things, the 85% if you're vested, 50% if you're not, 100% of the members, all the interest associated with that. So to me, that just kind of ensures fairness, kind of a guaranteed baseline value for every participant at the end of the day. Our provisions are meeting the goal exactly. Again, we're unusual and superior in this area relative to public pension plans across the country, because they just don't offer this level of minimum benefit, primarily because they only often return maybe the member contributions or far less of the employer contributions. So we're just very different on that side of things. So we have no changes here. We're meeting the objective and exceeding it in most cases. Tax qualified status, I think this probably goes without saying, kind of important, right? Matter of fact, Doug and I have talked a little bit about, does this even go in the front end with the sustainability side of things? Because this is obviously a very important one when you're looking at our tax qualified status. And of course, that's essential for maintaining the favorable tax treatment on those member contributions and the benefits associated with that. So, we've received our favorable determination letter from the IRS that confirms our tax qualified status. We've adopted initiatives and done those sort of things to make sure that we continue to evolve. with the IRS requirement and regulation changes. They change all the time, and we have to be able to evolve and adapt. And of course, we're currently, maintaining that goal. And of course, that's requires ongoing vigilance as well. We got to stay on top of those changes. And not only do we have, John and Sam that pay attention to those things internally, but we also rely on our external legal counsel experts as well. They focus on the federal side of things, and that's Ice Miller. Many of you saw Rob Goss come in and present the fiduciary presentation here a couple of years ago. He's with Ice Miller, and they, again, are the Fed experts, if you will, and are really good resources for us to make sure we stay on top of it. So again, we're achieving that goal today, but that's an operational priority that we continue to look at those things moving forward. Pretty straightforward. I doubt there's any comments on that one. That's pretty important. All right, we're getting to the end here. Member issues, I probably won't spend a ton of time here, although this is one of my favorite goals personally, because for us, I think we always want to continue to identify and formalize additional initiatives that may help us achieve our long-term benefit goals. Maybe it's even modifying those or establishing new goals as conditions evolve. So again, I think it really kind of reflects the SDRS's philosophy of continuous improvement and proactive long-range management at the end of the day, something that I've been very proud of our system for as long as I've been here. And I know it dates further back than that. We've been talking about a lot of these things that we've expanded on, or looked at. Of course, we've got our contingency plan that identifies how we'd respond to the good times and the bad times at the end of the day, but focusing on the good times, those initiatives and those things that we would consider if those conditions improve, and we'd have the resources to improve benefits. So again, I think we've got the framework in place to evaluate future enhancements and those sort of things. And of course, we're going to continue to have those discussions and as times change and continue to just review our contingency plan, and that all fits together. So I don't really have anything else to say on the member issues other than I think it's just a really important component to our goals. And I don't know, Doug, if you want to elaborate any further than I have, but I think, again, pretty straightforward, very important goal that we keep that in front of us. Nothing
Nothing to add.
All right. Nothing to add. All right. So we kind of look at the summary and the next steps. Again, I think when you look at all of the long-term benefit goals that we've reviewed today, I think nearly all of those are being met under our current provision. I think this reflects the strength of our system's design as well as our disciplined approach that we've taken over a number of years. I'm going to skip the cost of living adjustment because we're going to talk a lot about that in the next 20 slides that you guys get. I know you're excited. Look, again, sustainability, I'm not gonna beat that horse to death, but again, it's just we're sustainably funded today, but sustainability is not static at the end of the day. And so we're going to have to continue to monitor things, do risk analysis, and periodic adjustments are going to be required. I mean, just to continue to evolve and continue to preserve our current benefit structure on this fixed contribution model. I think that just goes without saying. We've had some really good discussion here today. Again, Doug and I had two pretty minor changes when we look at the order in which we presented this. I think the flow made sense. I hope it did for you guys as well. That is one change that we'd make to the document. The other one centered around that total income replacement, looking at the personal savings, adding the income from. I do think maybe there's some more discussion down the road on career and 50% income replacement. And if there's anything you guys want us to bring back on that, we're more than happy to, but that might just require further discussion. I don't think there's anything we can really do from there. Before you give us the thumbs up to proceed with any of these sort of changes, I do think we need to move to the next agenda item, talk about the COLA, because when we look at that goal, there could be maybe some changes there that we might want to consider for that goal. With that, Doug, is there anything else you want to add to the?
Well, just reaching back, right? Two goals we acknowledge we're falling slightly short of now, or short of the COLA goal, which we're going to talk at significant length next. The foundation Class A benefit multiplier for service after 2008 at 1.55 does not get you to that 50% goal for 30 years of service. But then a couple questions we had hanging out there is that 50% goal and the career service lengths as well.
Anything else to add?
I don't see anything. Move on to the COLA discussion next.
We'll go to the COLA discussion next. Item 11. Let me just get my stuff here. All right, as we said prior to the long-term benefit goals entire presentation, we just felt like the cost of living adjustment deserved its own presentation. Again, when you look at our COLA lagging inflation a little bit, being recognized in articles and those sort of things, there's just a lot more context to this and a lot more details. So Doug and I wanted to provide a lot more here. So I'm just going to jump right into the first slide, and I'm not going to spend any time with these first couple of slides because you've seen them already. But again, everything has to be grounded, centered around our mission statement and vision. Again, we have that responsibility at the end of the day to maintain a financially sustainable system. It's where we remain committed, is being fully funded in a model system at the end of the day. So again, we have to evaluate everything through that lens. Of course, our fiduciary duties. I think the only way I'll summarize this is, don't forget, we have the duty of loyalty, the duty of prudence, and the duty to follow the plan at the end of the day. I think they're pretty straightforward. You don't need me to talk about those again. When I look at the implications for the benefit goals, and again, we're looking at that fixed contribution model, we have to operate functionally within that model. Again, we don't have the ability to increase contributions to solve funding challenges. So again, we have to look at that long-term planning, and that's managing our benefits, our assumptions, and our plan operations. Again, we have that diverse membership, and we have to treat everybody fairly and consistently. We can't give a certain advantage to a certain specific group. And when it comes to the COLA, the one that I skipped in the prior presentation, we look at our COLA adjustments. They're one of the most visible features to our members, right? At the end of the day, once they start their benefits, each year they're looking what that increase is going to look like, especially looking at inflation as well. So it's one of the most visible features, and the COLA has to be managed to carefully protect the long-term affordability of the plan, I should say. The assumptions behind the COLA must be realistic as well as fiscally sustainable within that fixed contribution structure. And just as importantly, I think the COLA outcomes should be equitable. And that means that we're ensuring they do not unintentionally favor one generation of retirees over another at the end of the day. So if we go to the next slide and look at the goal, again, I think our long-term goal is to provide meaningful inflation protection after retirement and, of course, after termination of employment, even before those benefits begin. Again, I think the intent here is to help our members maintain the purchasing power throughout their retirement, or at least to a certain level. Current provisions. I think we know our provisions. Doug's spent a little time on that on his update of the funded status presentation. He actually has a slide coming up on it again as well. And so I won't dwell on that, but we know we have our 0% minimum, 3.5% maximum. We know how we have to adjust that based on that maximum, based on affordability at the end of the day. If you look at in the recent years, you look at our COLA relative to inflation, we've lagged, we've trailed it, right? At the end of the day. So in essence, if you look at it just from a COLA relative to inflation, our goal hasn't been achieved at the end of the day, just to call it out how it is. I will tell you, I think that the COLA is one of the most significant challenges for this board on a long-term basis. When you look at the COLA structure, the intent here is to maintain our sustainability, but during periods of high inflation, that means it can lag behind those rising prices at the end of the day as well. So, but currently that goal is not being achieved. When we look at the COLA goal and expectations, and Doug, jump in on this one as well as you feel you need to, maybe wanted to give a little historical context here first. When you look at prior to 2021, our stated COLA goal was intentionally modest. It was described as limited COLA protection, or excuse me, inflation protection. prior to 2019. At 2019 through 2021, it was switched to partial, from limited to partial inflation protection. And again, that was intentionally modest, recognizing that we could not always keep pace with inflation. In 2021, when we reviewed this document and made some minor adjustments, one of the minor adjustments was removing that qualifying language and looking at the goal as more of an aspirational ideal rather than maybe a guarantee. It's what we aspired to do. We knew that it wasn't reality. And with that discussion, we also recognized that this shift would mean that we were going to have to communicate this very well. I put a real emphasis on our communication, really clearly describing what the COLA can and cannot achieve. And so over the course of time, when you look at our updated to our funded status and those sort of things, we've highlighted for several years that our COLAs have not always kept pace with inflation. We've been very upfront about that and recognizing that we know that our COLA can't always keep pace with inflation. And that was a discussion with the board. And part of our contingency plan was recognizing that if we have increase in dollars, we would take a look at those folks. And we talked about that, and Doug will talk about it coming up, whether that's through, something with the COLA, or is it the multiplier? I mean, is there things that we can help people out in that area? And I really believed at the end of the day, it was consistent messaging that we were providing at every one of our meetings. So our members didn't assume that our COLA equals full inflation protection, which has never been the case at the end of the day. I look at these communications and I feel like we've maybe failed in that area, and that's my fault. That falls on me at the end of the day. We should have done a better job of communicating this. I think for some of our members, certainly not the majority, even in visiting with Wes during lunch, definitely not the majority, but some of our members and those sort of things may have looked at this now as an expectation that our COLA is always to keep pace with inflation, even during high inflationary periods. So communications definitely could have been improved, and we'll look at improving those in the future, but that again falls on me at the end of the day. I think we need to continue to, do those periodic comparisons with the COLA inflation and show how they've lagged inflation, because again, that's consistent with our design and the constraints that we have. And I think we need to discuss that. And I think we also have to draw these comparisons to help set realistic expectations and prevent misunderstandings of what we can deliver and cannot deliver. Just to provide a little bit of national context, and Doug's going to get into this with some really good slides, there's no state retirement system in the country that has delivered inflation matching COLAs on a consistent basis. This is a systematic nationwide reality at the end of the day. It's not unique to South Dakota or the South Dakota retirement system. There's only one system out there that's kept pace with inflation. We talked about them a little bit ago, Social Security. And I don't know that I would use them as the model retirement system at the end of the day, especially just learning yesterday that trust fund is going to be depleted by now, 2032 is the new number, if I remember correctly. So I don't know that I would look at that as being the model at the end of the day. Again, I want to just reinforce as we get into Doug's discussion on this, reinforce the fiscal limitation. And Doug's got some really good slides on this. You've already seen them earlier. We operate on the lowest pension spending in the nation. And in my view, I think that makes matching inflation in all periods virtually impossible, if not just flat out impossible. I just don't think there's any way you can do that. We operate on so much less. Our focus should be on delivering stable, sustainable COLA that protects the system and its members over the long term. So given all that context, we're going to have a lot more discussion on this. I'm going to turn it over to Doug, but Doug, before we move on, if there's anything else you want to add to this slide or anybody else, feel free to do that. I will say before I turn it to Doug, though, one positive thing I feel is that, and I should address it, is SDRS has always provided a COLA. And there are many pensions across the country that cannot say that either. And we've always provided a COLA. And I think that's something to be proud of as well. But I'll turn it to you, Doug.
Yeah, I just, we went through this exercise, and I think Paul led us through this exercise 5 years ago, right, over the course of 3 meetings. And we had a lot of discussion. Do we keep that qualifier in there? Should that be, the limited or the partial inflation? And we ended up taking it out. And I find it interesting looking back, I didn't remember when we started out this process that we had actually talked about managing expectations back in 2021. And this is before inflation took off again. That this is our goal. This is what we're shooting for. This is the ideal. But we're not always going to be able to get there. And we talked about that in 2021. And in our comparisons, maybe we've kind of lost sight of that in the meantime as well. As we go on, you've seen this slide, right? But we want to set up here. We've been on the current COLA process for 9 years now. So 8 years of changes from 2018 to 2026, the COLA that we'll pay next month. And if we hit our assumptions, if investment return is what we assume on a long-term basis and we don't have other gains and losses, we expect that maximum COLA to stay stable. So there's going to be reasons that it changes from year to year. And we wanted to look at what has caused this to change over the 8 years of changes from 2018 to 2026, and then focus in on the last 5 years as well and what has driven the changes. So if we look, the middle set of columns here, the total and the average for those changes over the 8 years, what caused those to move, and then the last 5 years at the right. And focusing on the bolded numbers, right, the investment losses over 8 years have averaged $15 million a year. Well, that's about equal to 1 basis point, 0.01% of a COLA decrease each year on average caused by the investment losses. Over the last 5 years, it's actually investment gains. So that's been upward pressure on the COLA each of those years. On the next bold line, the total liability losses of about averaged $80 million a year. So that would be downward pressure on the COLA of about 5 basis points a year, even more so over the last 5 years. So the liability influence has been more than the asset influence on that COLA. The 2 lines below that, we made assumption changes, actuarial assumption changes in 2022. That was a one-time change that pushed up or gave some upward pressure on the COLA. And then the contribution impact. Here's what I mean by that. Our contributions are set at 6 and 6 for our Class A members. When we're only able to provide a lower COLA, well, the cost of the benefits accruing during the year goes down. So we've got this gap that provides extra contributions that actually provides upward pressure on the COLA of about 1 basis point, again, 0.01% per year. Right. So I want to focus here on one thing that has been probably the biggest driver over the last 8 years and over the last 5 years, and that's our salary losses. We had, going back to, we expect about a 2.5% inflationary increase for that each year. If we go back to 2021, it was 2.4, but there was some extra, and I always look at Darren because he knows the history, I'm sure of this, some extra effort to bring people up to midpoints at that point. Then in 2022, we had a 6% inflationary increase, 2023, a 7%, and 2024, a 4%. Right, those are all the increases that were baked into those, which were extraordinary, trying to catch up for some really high inflationary periods. That's all in the past. The salary increase that we'll recognize when we do the valuation at the end of this month was July of 2025, which was a 1.25% increase. So we're going to have salary gains next year, probably ballpark about $100 million. So that's upward pressure on the COLA for next year. Then we have a 1.4% increase baked into the budget for July of 2026, which will impact our June 30, 27 numbers and our 2028 COLA, providing more upward pressure as well. And then finally, just watching the budget process this year, albeit from a distance, it doesn't seem like there's a lot of money floating around to increase salary. So I think in the future, probably definitely the next 2 years, probably reaching in the future, we're looking at salary increases below what we would expect in a typical year. And that would help bring that COLA back up as well. It's easy. We often just focus on the investment return because there can be big swings on that. But actually the salary changes have been the primary driving force in the last several years here as well. I don't think I need to go through this again, right? We know what the current COLA process is. This is how we got to the 1.56 which is the most we can afford based on our June 30, 2025 valuation. And that's the COLA increase that will be applied to all of our benefits in the July. So we know that the first is the current provisions that are the top two paragraphs there. But I did want to talk about the purpose again, and we mentioned this early. So we expect that COLA to stay stable if we don't have unexpected things, but we do have changes different from our assumptions in the investment return and the liabilities each year. So each year we take a fresh look and say, based on everything we know today, what's the most that we can afford for the lifetimes of all of our members, from our oldest retiree to our 18-year-old just hired, and what can we, what's the most we can sustainably afford, and that'll be our limit for the COLA, with a cap on that of 3.5 when we can afford the full basis as well. The COLA is expensive. At our full COLA range, when we can afford that full range, it's about 20% of SDRS costs just in the COLA. So about $3 billion, about $73 million a year in contributions when we can afford the full COLA range. We can't right now, right? We've got this limited COLA of 1.56 at the moment. We expect it to go up for next year. But at the 1.56, it's about 13% of SDRS costs, about $2 billion of cost wrapped up in that COLA, about $50 million, $47 million in contributions each year. The bottom point on this page, right, are what we'll pay in annual, well, monthly benefit payments. The annual total of that will be about $800 million this fiscal year. And it's easy to think, well, a 1% COLA then is 1% of that, so it's $8 million. But it's not just that, right? Because it doesn't just increase this year's payments, it increases payments for the rest of all of our retirees' lives. So we carry about $9 billion in liabilities for our current retirees. So a 1% COLA at our current COLA level is about $92 million. So it is an expensive feature, right? There's a lot of leverage in this, which helps us, right? When we're trying to maintain sustainability on fixed contributions, this is a powerful adjustment. But when we get behind, it's really expensive to catch up on this as well. December, the last time we showed this chart, it might have been December, right? And we're trying with this chart to capture how all of our current benefit recipients are doing, how the COLA is doing in keeping up with inflation. So each column is a cohort of retirees, those that retired in a specific fiscal year. And if that column is above the line, those people are ahead of inflation. If you're below the line, you're behind inflation. And we see some groups from the 2016 to 2023 that might be about 10 to 12% behind where their benefits would be had they kept up with inflation. 93% of our folks trailing inflation. Now, we usually, when we talk about this, say there's two mitigating factors. One is just about everybody's in Social Security. Social Security has kept up with inflation. The other one is this ignores benefit improvements, right? And we talked about in the early years of SDRS, for the first couple decades, there were a whole lot of benefit improvements, and we aren't baking them into this as well. So how did we get here? How did we get to where we're at? Wanted to walk through this history, right? Because we started out with a 2% simple COLA, right? So if you have a $1,000 benefit for the rest of your retirement, it goes up $20 per year. Right? In I don't have the years on mine. 1978, that went to, it was indexed with inflation, compound with the 2% cap. Then in 1982, went to a 3% cap, but still indexed, so we wouldn't pay more than inflation. In 1988, we went to a 3% fixed compound COLA. That can be pricey, right? We're locking in 3% regardless of what inflation is in that year. And then it went up in 1993 to 3.1%. Great financial crisis, 2010, there was legislation in 2010 to fix the COLA at 2.1% for 2010. And then we went at our first shot at a variable COLA from starting in 2011, that ranged from 2.1 to 3.1. In retrospect, we didn't build enough variability into that. We ended up paying either 2.1 or 3.1 for each of the periods in there. So in 2017, we took another crack at it and went to the current COLA process, but with a 0.5% minimum. And then in 2021, we took that minimum down. I'm saying we took. The board recommended to the legislature enacted all of these changes. That's where our COLA's been. If we compare that to inflation, I'm amazed at the late 70s and early 80s, right? Look at where inflation ran during those periods and then spiked again 21 and 2022. So if we look at the difference in those, we get a big gap, right, in the late 70s, early 80s, where we really lagged inflation, and then again 21 and 22. Now, if we go back and we look at what the investment returns were, they were great, 70s and 80s, right? And that allowed us to, instead of these COLA increases, there were benefit improvements. The 1% became 1.7% eventually. That makes up for a lot of missed COLAs if you're doing a 70% increase in your benefit as well. But we have not had the opportunity to do any benefit improvements since 2007 was the last one that was enacted, right? We have not reached the board's policy for benefit improvements. So a lot of the current deficit comes from the last couple of years, that 21, 22, where we were significantly behind inflation. So if we go back to the cumulative chart, and we're just going to group some of these members for the purpose of those bubble charts, right, to kind of group continuous years together that had similar percentages. And if we look at where the COLA is compared to keeping up with inflation, right? And these are all of our current retirees. The groups, again, continuous years, so we're trying to get similar percentage, and we're doing a weighted average here. So we've got some very small groups of people that have been retired 45 years or so, or 40 years, that are lagging inflation a little bit. A lot of folks right around 100%. We've got a big group who retired between 2016 and 2022 that are about 11% behind inflation. And then a group of the last 3 years that are about 2% behind inflation. Again, here, the size of the bubbles, how many people we have in there. Now, we kind of hinted at this next chart, right? We're going to try and adjust these COLAs for where the multipliers have been improved, or where the multipliers are above our multiplier that would get us to 50% for the defined career, right? So this takes some of those earlier years that have had the benefit improvements and raises them. So really, our groups from 1990 through 2009 are right about or above 100. Our retirees from 2010 to 2015 lagging just a bit. But we have these last two groups there that are about half of our retirees, right? That are 11, 12% behind the combined goal of the multiplier and keeping up with inflation. So, and Eric kind of hinted that, well, he mentioned this before, right? In our contingency planning, we have an adjustment for inflation if we ever have money to spend on benefit improvements. We also have identified a benefit multiplier increase. Looking at this might maybe elevate the benefit multiplier above that and use the multiplier for that service after 2008 that has not been improved. Those are the folks that are hurting right now, that have both lagged behind the goal on the 50% multiplier and on the inflation keeping up, or the COLA keeping up with inflation as well. I should have said on this slide, this is just Class A foundation folks. We have so few generational members that are retired at this point. They would hardly be a blip on this as well. Public safety members. Well, when their service before 2007 was improved, it was improved from 2% to a 2.4% multiplier, disproportionately higher than the Class A folks, right? So most of these folks, if we looked at the combined goal of a 50% multiplier and keeping up with inflation, most of the public safety folks are pretty close to where those two combined goals would put them. A few that are maybe 2% behind that. But that speaks more of that improvement that was made, and maybe we were over generous with that improvement for service before 2007, or disproportionately beneficial, I guess would be a better phrase. Now, as we try and put this in context with statewide plans, two reminders that we spend least on pensions in the nation. And NERS looks at us and says we're the most efficient in the nation in providing benefit payments and economic impact from those benefit payments. NASRA, everybody should be familiar with the NASRA website. And if you need help finding it, reach out to us or getting logged in. We might be able to get you logged in. They have a great brief on COLAs around the country and all the state plans around the country. In fact, it was updated and released today with a new one. So this is out of date, what we've got here, but you can find it on the website. I haven't looked at the updated brief yet, but it was in their news clips today that they had a new release of this out. So I'm looking at a 2025 report, so there shouldn't be a whole lot of changes. The chart at the bottom shows the states that changed their COLAs after the great financial crisis. We're in red, as are a bunch of the states. They impacted retirees as well as active members and new members. The dark blue affected current members, and the lighter blue just new members. So there are some systems that put in a new tier with a lower COLA. And what we're going to do next, we ignored the new tiers, or I'm sorry, the old tiers, the closed tiers, and what we're doing. So we wanted to look around and say, how are COLAs in first our regional plans around the region and plans around the nation. So first we're looking at plans around the region, and we're looking at the average COLA over the last 5 years. Now the red line in there is where inflation has been, an average inflation for the 5 years. And I'm using a December CPIW number. We've got June 30 plans and 12/31 plans in here. So whatever measure we use, it's going to be around 4.5 for those last 5 years. SDRS, we've provided a 2.15%. That's the average COLA over those last 5 years. If you look around the region, the highest other one is Idaho PERS at 1.56. Some of the Minnesota plans at 1.55. The COLAs go at least as low as 0.5% COLA in Montana, their teachers plan. In the box are 4 other plans from the region that have no COLAs, right? Either no COLAs or it takes a special legislative action to provide any COLA as well. So what this says is, if we look around the region, SDRS has got the highest COLA of any of these plans in the region. Now, there are some tiers that were closed in 2007 or 2013 in a couple cases that did provide a higher COLA, but they decided they couldn't afford those going forward and closed that tier and opened a new tier with a lower COLA. All these plans have unique benefits, retirement ages, contributions, but we wanted to look at, okay, if we look at some of the financial features of them, if we look at contribution rates and whether you're carrying debt and what you're assuming as far as return, well, everything shaded in green for these plans says these plans should be able to provide a higher COLA than SDRS. With the exception of Nebraska schools, they have actually a bigger asset than we do. They don't carry any debt. Everybody else is carrying debt, contributing more, sometimes significantly more than SDRS members and employers, and assuming a rosier future as far as investment returns as well. Again, so if we look around the region, the conclusion is we've got the highest COLA with the lowest contributions, the lowest assumed investment return, and not carrying any debt. So it's hard to imagine us doing any better compared to the region than we are. Now, if we look around the nation, we look specifically for plans with a more favorable, a bigger COLA than SDRS over the last 5 years. And we found, I think there's 15 we showed here. A couple of them represent 2 plans, so that maybe there's 17 plans here across a dozen states or so. None of them approach inflation. None of these systems are matching inflation. You see the SDRS line at 2.15. Wisconsin at the right, 3.38, the highest COLA over the last 5 years. I should have put an asterisk on this, but please do on yours, right? They have a COLA that goes up when their investment return is favorable and goes down when it's unfavorable. And then after the financial crisis, they reduced benefits for 5 years in a row, from 1.2% decrease in one of the years to a 9.6% decrease in 2012, right? So they give a bigger COLA, but then they claw it back if you have investment losses. The other plans, Missouri has some plans that have been paying over 3%. Again, more favorable than SDRS. But if we look again then at the financial features, Missouri, for example, and some of their plans are in Social Security and some are out. So we're trying to adjust for that. Just about all these plans contribute significantly more to their plans, both on employer and member contributions. Most of them are carrying additional debt. I shudder to even look at the Illinois debt number on there. That's across a couple plans. And all of them are assuming higher investment return, which would lower the cost of the benefits and the COLA as well. Washington stands out. Washington is interesting because in 2025, they had a big budget crisis. And so to avoid having to pay more for their contributions to the pension, the legislature dictated that the pension plans would they mandated that the pension plans would use a higher investment return to lower the cost of the pension plans this year. So it was kind of a backwards process. This is too expensive, change your assumption, let's lower the cost. But that's how they got to where they're at now as well. Again, around the nation, we do find some systems paying a bigger COLA than us. For everyone that is, there's a reason for it, right? Higher contributions, carrying a lot of debt, assuming higher investment return as well. And why are we doing this? We wanted to put this in context, right? We have this goal of matching inflation or our COLA inflation protection through the COLA. But we wanted to give you the context that used to be partial or limited, and we talked about this being aspirational. We also wanted to look around and say nobody is able to match inflation with their COLAs around the country in state plans. And we are providing the highest one in the region, one of the highest ones in the nation, if we take the nation as a whole, on fixed limited contributions as well. With that, we come back to the goal, right? And we ask the question, right? Is the goal, we changed it in 2021 to take that qualifier away. And we think it may have, in tracking our progress against inflation and maybe emphasizing that or maybe overemphasizing that, maybe we've communicated that the expectation should be that we keep up with inflation. So we wanted to just put this out there again and say, you know, what do we think? Is the goal where it should be still? Where do we go from here with this?
You know, again, Doug's kind of alluded to this already, but, you know, is the current goal, does it remain appropriate given the financial realities, the inflation, volatility, member expectations? You have to consider all of those things when we're looking at this goal. And I do think this opens the door for us to re-examine this when it comes back to whether our stated goal and the achievable outcome are aligned at the end of the day. I kind of find them to be out of alignment personally. But I'd like all of your feedback because at the end of the day, this is your goal. I do think maybe one of the central questions, again, as Doug said, do we need that qualifying language again? Is partial or limited? Maybe alternatively, do we narrow the focus of the goal on maintaining purchasing power only during low to moderate inflationary periods? You know, acknowledging that full inflation protection during high periods of inflation is not feasible at the end of the day. Maybe it's even clarifying what inflation protection means, all of those sort of things. So at the end of the day, I think we just need to have really good discussion here and see what you guys' thoughts are. I think if you can get those back in alignment, it does make the communication efforts a lot easier at the end of the day if your goal is consistent with the outcome. So something to consider as you guys throw out ideas.
You know, I certainly don't want to, you know, if you're gonna give full COLA and inflationary protection, you're gonna have to lower the upfront benefits. I don't want to give up the upfront benefits so that I have total inflation protection. I don't think, at least the membership I represent, would rather have the benefits up front and less protection on the inflation side than to have a lower upfront benefit, and so when they're older, they have more of a protection.
That's part of the discussion with design back then.
Yeah.
Benefit improvements throughout the years.
And I think we wrote the rules to basically do that, you know, because the way the COLA is written right now, it's impossible to keep up with full, unless there's just extraordinary circumstances, but there really could never be. We're always going to fall a little bit short. As you can see, they're doing across the country. And I think purposely we've done that because we want to maximize the upfront benefits. Now that's kind of a philosophical discussion, and that's kind of what I thought of this whole thing. You know, anybody else wanted to chime in on that?
I do have like one question. Do the retirees that are currently polling, do they have any complaints with our current COLA or how we're handling the situation?
No, I talk to our director of member services all the time. I just was talking to our retiree representative during the lunch hour, you know, and talked to a number of other folks on our staff. And we don't get much for complaints here. I think, you know, we're going to have some. That's just part of working with the public. You're never going to keep everybody happy at the end of the day. And I think we've all accepted that. But I would say the vast majority of the members understand the design at the end of the day. I think, again, kind of going back to the Wisconsin plan, I don't think they would want a COLA set up like that where it increases for multiple years and all of a sudden investment performance is different. And now we have to claw back benefits. They're not going to want that design. And so I think people are fully supportive. Typically what we hear is don't cut our benefits. And I still firmly believe that's the position of the majority of our members. And I talked to Wes during the lunch hour and he made the same comment to me. And so I feel confident in that. And again, talking to, you know, Michelle Human and some of the others, I feel confident. We just don't hear a lot on that. I think people understand it. Doesn't mean that we always like it and that we're not feeling the impact of inflation, because heck, we all are at the end of the day, even in our working environment, when salaries don't keep up with inflation all the time. We know that they don't, even when we're working, and we can kind of feel that pressure too at the end of the day. So to answer your question, I think most of our members are supportive of our design and understand the structure.
I'm newer to the board, but back in the day, there was a couple charts on here. Back in the day, they gave really high COLA increases, and then there was caps there. Is there at a point where if we can't have too much money where we have to give those large increases?
I think you kind of talked about it a little bit earlier, maybe circle back to that.
It's too much money.
Because I'm sitting here going, why didn't we save it just in case or hold on to it? Or
Boy, we had a lot of great discussions in 2007 as Matt was around and Eric was around, right? The board has Well, it's got a longstanding policy on recommending benefit improvements only if we're above 120% funded. That's the easiest of the criteria. After you increase benefits, you have to pay for the increase and still be over 120% funded. And there's a timing component that if we have gains, we don't recognize those for 5 years for that purpose, for the purpose of considering improvement. So we don't have a temporary increased benefits, and then, well, like it happened in 2007, the market crashes. There was a lot of discussion in 2007 when we made recommended that last benefit improvement, and Matt was one voice saying the markets are way overvalued. Does that sound familiar for me earlier today, right? We shouldn't be spending this money, or we shouldn't be spending enough, or we should put in a way to undo it if things go bad. Well, things went bad, right? And we didn't decide to undo it. We decided to make changes to the COLA instead on that way. 120% is kind of the minimum line we would want to be before we spend money. When we spent it before, there was a lot of discussion in 2007, the last time, fearing what actually happened. Matt, maybe you should go on some more about that.
Yeah, maybe I can go back to 99 first. The time before 07 when, we were in a financial bubble, in hindsight at least. And now, we're worried the markets are high, but, the proof will only come, if it falls. And even if it is, it could get bigger in the meantime. But back in 99, markets were very high, like they are now, even a little bit higher. We saw earlier on the chart, could be, like markets going up another 20%, then it might look like 1999. And there were groups outside of the STRS board that requested legislators consider benefit increases and to use that extra money, because, we were well over the 120% at that point, but we didn't have a 120% rule then. There was no rule then. It was just ad hoc discussions and, maybe investment people, if the markets were high, expressing caution about how this might not be sustainable, and others, wanting to utilize the opportunity to raise benefits while they could. And so there'd be all that give and take. And 99, I believe it was, or 2000, I can't remember, right before the downturn, right near the peak. And then there was that discussion, and there was bills put in to increase the benefits, and we testified. I actually testified personally because I was stuck in Pierre in a blizzard, and the boss couldn't get there, and so I testified on behalf of the group about what would happen if markets reverted to fair value, and walk the Retirement Laws Committee through the discussion, that resulted in the conclusion that there was no extra money unless you think a bubble can persist. That if markets revert to fair value, there is no money, and it wouldn't be appropriate to increase benefits that we're going to be forced to pay forever. And, with COLAs forever. We probably pointed out a quote by Warren Buffett that said you should not, increase permanent benefits with impermanent monies, monies that fluctuate up and down, here today, gone tomorrow money. And so you need to be sure. And maybe to the extent that, you hope you have extra money, but you're not positive, but you don't want to just pile it up forever either. I mean, we're here to give money to our beneficiaries, right? That's the whole purpose. And that's when discussions started about, well, maybe we vary the COLA a little bit, because then it doesn't all go up in a formula right away. We can always adjust it. We're only stuck with that 1 year's COLA promise, and the rest of the COLA promise is out into into the future until that 18-year-old kid finally, is gone, that Doug talked about a few hours ago in the system. You have the ability course correct more easily with the COLA, but then all of those discussions and then the market crashed and everything, all those conversations disappeared. Well, then back in 2007, they're back. We've made all this money, and the council had a lot of investments in real estate and a lot of aggressive investments, and piled up a lot of money, and we were way ahead again, 132 or 133% funded, and then the question was, well, let's spend some of that, and so. Then there ended up being discussions about, well, don't remember the lesson of last time, 99, and should we not spend it all? And there ended up being a compromise that maybe they would spend maybe a third of the amount that, proponents of increased benefits wanted, as long as we had clawback language explicit in the legislation that it can be taken back. And then we also, I think around that time, as part of that discussion, said, let's have, I think, was it then, anybody else remember? Maybe I'm the only old one that goes back that far. Wes, maybe it took a break. He was probably on the council then. Yeah, and so the idea was, well, let's not get in these jams again. Let's make sure that have that extra 20%, cushion. There was a lot of discussion about whether it should be a 30% cushion, because, even after 99, when things cratered in 02, we were at the end of a fiscal year, 76% funded, right? Was that then, or was it? Yeah, and we had to, make changes, and that was very painful, and it was a lot worse, in March. That was 76% at the end of the fiscal year after it bounced back. It was very scary in March, around the bottom. I remember meetings that Paul Schrader and I had with the governor back then about where we were at, because it was very scary. And, if you're 55% funded on an interim basis, that's not going to work. And so fortunately, we bounced back to 76%, and then the markets, we had good returns after that. And, but the idea was, let's not get in that jam again. Let's have that 20% cushion. I had argued for 30, but there was a lot of discussion about how, we can vary our assumed investment return. And if the markets are in a big bubble and these expected returns from there are diminished, we can lower our assumed return a little bit. And we have lowered them. At one point, they were 8%. And then I think they were cut to 7.75 about the time my predecessor retired, back around 2004. And then in the next several years, we had initiatives to take it down to 6.5. And now we have this idea that there's a threshold around what the investment council expected return is. Annie pointed that out this morning in her presentation, what we would expect. And that if we get outside of a certain band around that, we're supposed to talk about, do we adjust that, expected return? And so you don't need quite as much cushion if you reflect some of the overvaluation in diminished expected returns from there. And so as long as that is done, then I also agreed then maybe 20% is a good answer at that point. And so that's kind of, I think, the history of all that. And I think we're in a good place now, but you have to evolve from your experiences. And this thing started a 1% formula, and I didn't know what to do with COLAs. And we started off when stocks were dirt cheap, 6% dividend yields, a 6 PE, and double-digit interest rates. You could earn on government bonds, and so money was easy for a long time. And it's tougher now, I think.
No, it went to 775.
Mr. Chair, that was Steve Meyer's last meeting. I think roughly probably fall of '04. It was a, yeah, I think it was, and we had one vote margin votes later as well to get to the 6.5% later and with the generationals. And so, but I think we've all had collective experience together and seen what's happened, whether people have been on the board a long time or they've seen what the markets have done, you know, separately from being on the board. And so, you know, we know it's tough when the future is so volatile, you know, unknowable and volatile. I mean, anything can happen. Maybe it's going to be way better than I think, or maybe it's going to be way worse than any of us think. And so we have to have the flexibility to adapt, I think, is the most important thing, and not make unalterable promises that we can't be confident we can meet, because then we're not, you know, basically giving the truth, you know, to our members. They need to know what they can count on and what might vary, I think is important.
You can't set your expectation on just what today looks like, because they set that 3.1% fixed COLA in a period of high inflation, and I think they thought it would never drop below that. Well, then inflation went to historic lows for years, and we were still paying a fixed 3.1%. That's why you see a lot of those people above in that time range was we had set that fixed COLA that was historically low inflation, and that was unsustainable. We couldn't afford that with low investments. So that's why you got to have a bigger horizon than what's going on right now.
So one of the things that, sorry, Travis, one of the things we started this conversation with was we feel like we're setting an expectation with the way the goal is currently written, that people expect that we're going to have a COLA. And I think all of this has led up in good transition to your comment that this goal is written to say that that's our goal, right? We want to give the COLA. That's an unreachable goal. It's been proven since the foundation of the SDRS. And if you look back across the last 50 years, inflation's been higher than 2.5% basically on average. So to me, you're missing a word, and the word is affordable inflation protection at the beginning of this goal, such that you don't set an expectation that we're going to make it. We're going to do what we can, but we're not going to meet COLA. And it shouldn't be the expectation that we meet COLA. So not to bring this to a conclusion, but it felt like we were close anyway.
I really like that. I like that better than what I would have thought of how you addressed fixing that, I think. And I think it also ties in with the other point I was gonna make, which is, you know, let's say that we do go through some times. Let's say inflation moves up 5-6%, gets back like the 70s, and you know the stock market's gonna do bad, but we're not gonna get totally killed because we're so defensive. We've got tons of cash, and interest rates go up. Well, that'll hurt our bonds, but we don't have that many bonds anyway, do we? And we've got all that cash, and when if the interest rates get higher, and the stock market gets cheaper, and then we can put money to work kind of based on that kind of low valuation, high inflation environment, we'll earn better returns, from there. And it may not help us relative to what inflation really is, but maybe we can pay more than the 3.5. If we can pay more and inflation's a lot higher and markets are offering prospects for lots higher returns than that, maybe we even can raise our assumed return to 8, when interest rates are 8 anyway. And that could happen in theory. It was the case in the 70s. And if it did, then we'll be able to pay more for inflation than our 3.5. It still may not fully keep up with whatever that higher level is, but I like that idea because we want to do whatever we can.
Mr. Chair, I'll give you my 2 cents now for whatever it's worth. I work with 2 groups of people. Number one, the employees of the county. And of course, there's going to be a group in there that is always complaining about, man, that's a terrible return on your money, but they're not drawing anything out. They're still paying in. Now, the other group I work with is the Watertown area retired educators or school personnel is what it's called. We always used to call it retired teachers, but school personnel. I don't think I've ever had any of them, and I'm a member of that group, but I don't think I've ever had one of them complain about the COLA. They're worried about sustainability, plain and simple. Sustainability is the most important thing. Then I can sell a 1.5 or 2% COLA increase because of sustainability. I just said, would you rather have 4% or not sustainability? And they'll say, keep the sustainability. So that's the number one issue there. Thank you.
It's worth 5.
I think you're seeing you're even seeing your employers can,
Good government.
but your employers can't even sustain keeping up with inflation because your tax revenues aren't going up to match inflation either, which kind of is just economics. It's basically inflation's eating away at our standard of living, and it's very hard to maintain that standard of living if we're going to keep our economics the same as they are. Somebody over here have a comment?
Anybody else? Do you like the language suggestion that
Mhm.
Darren has made? I think it makes a lot of sense, the way it ties into a lot of the things that we talked about, quite honestly. Any other thoughts on the COLA? Doug, anything else from you on that? At this point, Mr. Chair, we don't need any sort of motion on this,
No.
but,
Well, we're gonna bring back
yes.
suggested changes to the document next meeting, correct?
Yeah,
Mhm.
that's where I was gonna go with it.
And
Yeah,
we'll
Doug already answered it, so
Yeah.
I won't even say anything.
We'll take
He's quicker
consideration.
than I
of-
am. He wants to get
Yeah.
out of here.
Out of the
and
hot
and
seat.
We'll take in consideration all the comments made and
Yes.
and when we write up these. And
As
so we'll
long as
see.
everybody's good with that, based on our discussion today, we'll bring it back. I promise you at the September meeting, and well, I guess unless you guys want to drag it out, but it won't be 2.5, 3 hours long. I promise you that.
Okay.
Okay?
Well, I think we better move on to item number 12 then. And well, you're gonna help me with this, but so.
Jackie will as well. She's
Yeah,
gonna-
Jackie will as well. So we had commissioned Paul actually to start this governance manual. And Jackie's taken over kind of writing this up for us. But as we're going through this process, we've identified a lot of policies and procedures and committees that the board has that we wanted to formalize so we can put it in this manual and been working with Jackie and other staff as to formalize some of these things. And most of these things are things we do already. But like Wade Hubbard used to say, we're going to codify reality and basically write down what we actually do. And as you look at these are things that we want to have in our policy manual, both for when we're giving orientation to new people, but also for our reference as how the system runs. And one of the most important things, and I've heard this for years, and not just on this board, we actually haven't had much trouble on this board because people seem to know these expectations, but it actually talks about this, especially for new people, that, we act as a fiduciary. We're responsible for 105,000 people's pensions and billions of dollars of money. And so we need to act in the best interest. And this just kind of sets the expectation that board members have, that you need to respect the organizational roles. We all have a role on the board to set policy, to direct the organization, but to actually run the organization is going to be staff that we hire. And then it says down some of that, conflicts, that we need to disclose conflicts. With everything that's going on in the world, we need to be above reproach. And really, if there's any conflicts in there, it just affects the whole system. And this it really sets out what our expectations are. The board's voice, one voice, and actually some of the later policies actually go into this in more detail. But, the board needs to have one voice. We can't have 16 different people giving 16 different opinions about where the SDRS is going. And that's why we have official spokesmen who are going to address legal questions or benefit questions or policy questions. Supporting the majority of positions. And these are basic things we've been living by. but we wanted it formalized in this, and there's actually, I always forget the second page, but confidentiality of executive session, thoroughly prepare for your meetings. It's not good when you come to the meetings and you haven't even opened the packet yet, because it's really hard to participate in discussion, especially at this level with this many people listening if you're not prepared. And we do encourage engagement. There's been good engagement today. You get into these policy discussions, this is the place we want to hear all the different opinions and to be at the meetings. It's so important to be at the meetings. But that kind of summarizes, the board member expectations. I mean, we've even gone so far as thought maybe there's something that should be signed by new members that this is what we expect when you get on this board. But we at least wanted it in that governance manual. Did you have any more comments, Jackie, on that item?
No, I think you covered it well. As you said, these are practices that I think the board has been really good about throughout the years. But we just thought it was time to maybe put them in a more formal position paper. And since we're working on that governance manual, the timing was right.
Yeah, and I mentioned them. I said I was on a board that became very dysfunctional, and they brought in a consultant, and he wrote up a set of guidelines just about like this. And it's so important it's nice to have that down before you ever have problems. So that's basically the reason behind that one. We're kind of just going to go through these in order that they're sent here. But conference attendance policy, we always stress the importance of, we're responsible for billions of dollars and lots of people's lives. You need to be educated. You need to keep up on things. That's why we stress both bringing in people here to educate us, but also going to outside education where we can. I don't think we did change the wording on this conference attendance policy. It didn't really change the meaning, I don't think. I don't know if you wanted to address a little of that or.
Sure. There's several grammatical changes from our current policy. The only substantive change is in bullet 3, where it considered only the travel budget. Now it includes consideration for the volume of travel requests, the attendance history of that member, and how frequently that member has attended. So just a few more things to consider if the budget is limited.
We've never actually hit our limit on the budget because we don't actually have 16 or whatever people that travel to conferences. We have busy lives. But if for some reason we had a whole bunch of requests and 10 people wanted to go to a conference in Hawaii, there's a limit. There's actually a limit to the budget. And this kind of goes into and spells out a little bit about how we would figure out who got to go to a conference.
It'd have to be a conference somewhere else. Hawaii is automatically denied for everybody.
Yeah, exactly. But it does, and it talks about the organizations that we deal with, and that we don't completely limit you to the organizations we deal with. If you come up with a different educational opportunity, bring it to us. We can make exceptions for that. But this basically puts in writing our policy on what conferences you're allowed to go to and how we decide, especially if we hit the budget limit, on who might get to go. And of course, everything is brought before the board for approval. If there is some kind of an emergency thing, the chair does have the authority to authorize something outside of these guidelines, but nothing real changed there. It's kind of how we've been handling things. We get into the give policy, and this goes back a few years. Basically, can't remember my writing, but we changed the threshold for de minimis. Basically, you don't want to have to report every time somebody gives you a soft drink or something, but it sets a limit of was $25. We're going to raise it to 50, and it's been 25 for many, many years. And we thought with inflation, 50 basically is almost the same number as what we had said 15 years ago. And just so that you don't have to sit in and report every time somebody gives you a hat or something at a conference. But you had some more. And
I just want to clarify, and you're exactly right. I just want to clarify that if you do go to a conference or a meeting on behalf of SDRS and everyone at that conference or meeting receives something of value that's more than $50, that is not included. That's an exemption. We're talking about just something you as an individual alone would receive. So this doesn't come up very often at all.
Yeah, not too much in our industry. Even sometimes there's door prize drawings, and those are really because it was available to everybody. Everybody was in a drawing, and it was a lottery. It isn't like that was given to you because of something. But sometimes you do run into things where there's something special, and that would have to be reported. But it basically updates the policy and the minimum amounts. And we wanted that in our manual too. Why don't we go to the officer election policy? This basically writes down how we actually have done the election of the officers, of the chair, the vice chair, with the committee. If there's a vote, how we do the runoffs. It sets it down. And we actually had this big discussion a few years ago about how to pick. I guess it wasn't necessarily a chair. It was actually
It's actually a vacant position.
a vacant position on the board, but it could come and play on a chair too, and basically be the same procedure. Because before that, we didn't have a runoff procedure. You just kept voting on the same slate of people over and over again, and got the same vote over and over again. And it was like a never-ending cycle. So we wanted to just clarify that. One thing I found interesting is if for some reason the chair and the vice chair weren't able to complete their terms, that the longest serving person on the board would fill until it was able, the board would meet again and pick a new chair, which I don't know if that was ever told to me before, but it's never happened that I know of. So, should we move on? And if you have questions, let me know. Legislative policy, and this goes into basically formalizing that we work real closely with the Retirement Laws Committee. We invite them to come to our meetings. We actually go and present to them too. If we can't meet with them, we keep them apprised of what's going on, because we want to have their engagement. We want to be transparent to them. And then the second part goes into the board recommended legislation. We want everything that deals with retirement to be vetted by this board, that this board gets a chance to look at it, study it, and give an opinion on it. So anytime there's legislation that's proposed that we haven't seen or had a chance to weigh in on, we're going to oppose it just because we want time to review it. And I think currently what we have in retirement laws and legislature, they agree with that, because they like that this board of experts here, which we are, has looked at it and weighed in on it. So, and I hope that continues, but this basically formalizes that whole thing. Was there anything more you want to say about that? This is the spokesperson communications policy. It talks about who's responsible for communicating the board activity, board policy, answering questions. You know, if some big issue comes up and Keloland's here, we don't want 15 people giving interviews of what the board thinks. I mean, you're always free to give your own opinion about something, but as far as the board spokesman, we have set people who are going to do that here. But it makes for a very difficult position for Travis if people are giving opinions outside of what the board has decided, because it just makes it look like the board's doesn't have a unified voice, and we want to have a unified voice. Once we make a decision, that's what we're going to go with. And that's where we have to go with, because that's the decision of the board. Anything else you want to say about that? Trustee education policy, we talked about this a little bit on the earlier one with the education and board travel, but basically is we need to be engaged in education conferences, being educated. Like I say, we're going to be trying to bring people in a little bit too to be educated. Of course, we have our in-house people that educate us between Doug and our investment people that educate us. And actually, when you go to conferences, you hear the same information. You guys do a really good job on like the investment stuff. And, you know, as our board, and we have the SDIC, the investment council that does the investment for us. A lot of boards like us do their own allocations, and we would be responsible for that. But we kind of have the luxury. We have our own experts that do that. So, but this just talks about trying to stay up to date, be educated, and that we're gonna try to do annual training here.
Maybe the only thing I would comment on here is I'm gonna try to do a better job for all of you guys. We get a lot of different newsletters and those sort of things from the different organizations that we're involved with that I think would be really impactful for all of you guys. We get like the NASRA news clips. There's different things from NC PERS and other organizations I think would be of high value to all you guys as well. It keeps Doug and myself and others up to speed in the office on what's going on across the country and those sort of things. And so I'm going to try to do a better job of maybe forwarding those on to you. And if you want to keep up on it and read it, then you will. If you don't, I guess hit delete. But I do think it's very important for you guys to stay up on those things. And then, of course, we're going to continue to try to bring in different outside resources for our September meeting, recognizing that not all of you can make it to a conference and those sort of things. Sometimes our jobs just don't have those opportunities maybe to get away. So I would say if there's ever anything that you read or see that you think would maybe be of value to the board, and if it's a potential speaker we could have to come in on a national level, please share that with me, because we try to think of it as a group internally, but we might miss something too. So if there's something we're missing and that would help from an educational perspective for you guys, let us know. It'd be helpful.
Do we, I'm sure some of these organizations have online training too.
Yeah, there's some different online training vehicles that we could look at as well. I know like IFEBP has some different courses that you can take. I think NC PERS, I'd have to look again. I think they have some online things now. They've really opened up the door for a lot of educational opportunities. I'm probably missing some, but yeah, there's plenty of options.
And then there's webinars. I know Doug participated in that one webinar. I think you did, and I sat in on it. It's interesting.
That would be a part of it as well, as we would include you guys, send you some webinars that we think would be relevant for you guys as well, on top of just the news clips and those sort of things.
So it just kind of formalizes our training policy. The new trustee orientation, which we've been doing for several years. At one time, we didn't actually do an orientation for new trustees. I remember Rob used to come out and visit us at our offices. When I first got on the board, here comes Rob. He came to my office. Now we make them come here.
We do. And well, we found that it's kind of been beneficial even the day before their first meeting, because you're gonna, especially with all these actuarial concepts, if we can discuss a lot of these different things on the one day and then bring you into the meeting the next. It just kind of reinforces what you just heard the day before and just kind of builds on it. So you can kind of gain momentum as you go. So we found that to be valuable, I guess, at the end of the day.
Well, in the old days, we used to have a book that had all our goals and different procedures in it. And this basically is
this is where the governance manual will go.
Yeah.
In essence.
Basically, this is taking the place of that, which we used to, but then we went away from paper and we kind of got away from that whole manual. So this talks about the orientation. Next one's a vacancy appointment election policy. This is basically when there's an opening on the board and we have to appoint somebody. The procedure goes into the voting procedure, which we wanted to know, make sure it was clear. After that one time, we kind of were up in the air. Can we do this? It doesn't really anything new there, I don't think.
Nope.
Executive Director Evaluation and Compensation Committee. In the last few years, we had two committees to do this, where this would combine them again. Part of the reason we ended up doing two is because we were trying to revamp the whole evaluation procedure, trying to move away after Myron complained.
Put it on Myron.
I put it on Myron. But it was a big lift for that committee to rewrite that whole thing. And so we needed two committees. Really, evaluation and compensation kind of go hand in hand a little bit.
Yeah.
And so we thought it's a good idea to combine them. And then it talks about changing the timeline a little bit, because in the past we've struggled. By the time we evaluated and decided you need a bigger raise in salary policy, it was almost too late to ask, because we need to go through retirement laws. And it's a lot easier to do that before the legislature meets. So you have a chance to be talking to the legislators, to the retirement laws. So it changes the timeline a little bit on when we would do that, and it moves it to late fall rather than spring. Which
So when we were helping Eric create these, I was just kind of referencing the discussions that we had in executive session during my review, and kind of an interest in this. It just made more sense. And so there'll be a little bit of a gap between my next evaluation versus the prior, but by a few months. But it just makes sense at this point if we're gonna tie all that together and have it for the legislature. So it just made more sense. Is that fair, Jackie? Anything else you want to add? You good?
Oh, I'm good.
And a little bit on the evaluations on the compensation part, when the compensation committee's been meeting, different ideas and things we want to set as goals are kind of written in here about the plus or minus 10% of the regional. And so it basically puts in writing some of the things we've been talking about the last few years. But with our discussion, we decided it probably was one committee could handle that now. So we're going to combine them again. Moving on to the waiver request committee, we actually didn't have a formal waiver request committee, even though our policy says we're going to have a committee look at it if there's ever a waiver. We obviously haven't had a lot of waiver requests over the years, but figured we better have a committee since we say we have a committee, and it establishes the procedure and who's going to be on the committee. So that's just kind of something we needed to take care of. Executive session, yeah. Basically, and we do this training every year, and with all these new executive session rules, this basically puts in writing what we've been doing because state laws kind of made us do it.
Yep.
Talking about why you go in, how you announce it, what you do in, what you do after, and the training that we have to go through. So it basically formalizes what we're required to do anyway. So, but it's going to put it in the manual so everybody will see it. And that's all of them, right?
Yeah, that's all of them.
So we would need a motion to approve these.
I move to approve the Board of Trustees proposed policies, committees, and procedures as presented.
Is there
Second by
a
Oakland.
second by Jake Oakland? After a motion by James Apple. Any discussion on them? Did you want some, Wes? I know you have some on by that other committee. Did you want it? We could probably do that during that committee.
During
one.
that committee, we can
Yeah,
discuss.
that's
And
up. That's
in about
next.
two, it's about 2 items down the list. All right. Any discussion? All right, all those in favor say aye.
Aye.
Those opposed, motion is carried. The next items are appointment of some committees. The first one is the Executive Director Evaluation and Compensation Committee. And as you see on the memo that I appointed Darren Seeley, Jim Apple, Penny Brunken, Matt Clark, Justice Salter, and I'll be on that committee. I think it's more of an information thing. Anybody have a comment about that one? Appointment of the Audit Committee. This is basically the same as it was with Jill Leonard, Gina Gruis, and Victoria Heineck on that committee to serve on with the Audit Committee with the auditors. And that is the charter is included with the memo, it says here. This is the one that Wes has a comment about. I appointed the Class B, and right now our policy says that it'll be the Class B representative, which is Hank Prim, plus one other person that I appoint, which is Justice Salter. And you wanted to comment on that one, I know, so I will allow that right now.
Let's see if I'm on. Okay, so I'm wondering if we shouldn't be proactive and expand this committee, talk about it at a subsequent meeting as an agenda item, because once you have a request, it's a little late to make adjustments to the committee. I think it should be expanded. I have my reasons for that, but for now I would support it as presented and ask the chair and to put that on a subsequent meeting agenda in terms of the membership and not necessarily the scope, but the membership, to expand it to include more board members. So that's my point. And meanwhile, proceed with the approval as presented, and we look at it sometime in the future.
Yep, and of course, it isn't just the committee that decides, it's staff. There's a staff gives a recommendation to that committee and the committee gets involved, so it's quite a process.
Whatever.
Mhm. But you're basically saying it should be more than just 2 people from the board that are on that committee. Yep, we can talk about it. And we can talk about that. And we are getting more and more, seems like we're getting more and more requests for Class B. So, all right, duly noted. Well, that's an information item though. Appointment of the waiver request committee, and according to the policy we just adopted, it's it's the chair and vice chair, which is Jim Apple and I, and then I appointed Jim Twilliger to serve on that committee. He seemed to be the expert about conflicts, so take that,
Not sure
take
what that's
that,
saying, but
take
hey.
that for what it's worth. Not going anywhere with that.
Got that covered.
And the charter is included. So those are all information items, actually. Unless anybody has any other comments. Otherwise, we'll move to new old business, and you had the meeting dates.
Yeah, I mean, all it is there is that the future meeting dates are below on the agenda. You can see we have the 2027 dates out there, so please put those on your calendars. And if you have any conflicts, please let me know. I know Matt and we have the SDRS Investment Council weeks on a few of those, but I think that'll work out perfectly. So other than that, those are the 2027 dates, and that's it.
Mr. Chair, I think they're 2026 yet, aren't they?
226 dates and 2027. I added the 2027 on the bottom.
Yep, first two are 26 and the next four are 27.
Yep.
That way you can get them on your calendar for the next year, which I have already.
Yep.
All right, is that all the old new business? All right, let's move on to personnel matters, and this is an executive session for a planning, succession planning is what we're going to talk about.
Yep.
Do I have a motion to go into executive session?
I move to go into executive session pursuant to SDCL 125-21 to discuss items relating to personnel matters. Potential staff who may be invited to remain include Travis Holden.
Okay, we have a motion from Jake Oakland to go into executive session with you staying in here, of course. Is there a second to that?
Second,
Second from Myron. Any discussion? All right, all those in favor say aye. Those opposed? Motion is carried. You want to come in?
Yep, we're good.
All right, I'll declare us out of the executive session at 3:19. And basically, I think the only item we have on the agenda is adjournment. Is there a motion to adjourn?
Move to adjourn. Johnson.
Myron Johnson moves to adjourn. Is there a second? Any seconds? We're not going to debate that issue, so. All right, all those in favor, say aye. Those opposed? Motion is carried. We are adjourned.
Thank you, everybody.